It's Wednesday, July 2nd, 2025. This is Overtime. I'm your host, Chris Vecchio in New York, Ilya Spivak in San Francisco, Thomas Westwater in Chicago to start the show. Dylan Radigan should be joining us shortly. We're here to take you through the rest of this hour as we wrap up the trading day. Futures market closes at 5 Eastern, 4 Central. If you're on the platform, Tasty Trade, on the website, tastylive.com, welcome. Thanks for joining us. Come over to YouTube. Tell us what you think of these markets. When you think of these markets shrugging off a huge decline in Tesla sales, not as bad as expected. Maybe a miss on ADP, appetizer for the non-farm payrolls report tomorrow. Doesn't matter. We have a trade deal with Vietnam. Retail stocks doing quite well today. Nike taking another leg up. Apple taking a leg up. It's a good day all around. NVIDIA trading higher as well. S&P 500 very close, just so close to an all-time closing high here as we turn our attention to these charts. We're looking at a close for today of 62.75. Thomas, earlier on Futures Power Hour, we noted that the high was 62.78.75, so not there quite yet. For the NASDAQ, it's a resumption of where we were basically to, start the week a little bit higher from where we began the week. But racing yesterday's losses overall, a modest session, light volumes, low volatility, continued push to the upside. The big mover, of course, in the equity market is the Russell, which is up by 1.41% and closing at the highest level we've seen here in the RTY U5 contract since March. The cryptocurrency space had another good day where Bitcoin may be breaking out, and we'll have to get to that shortly. Of course, in bonds, we do see a bit of a pullback as Trump's bill meanders its way or snakes its way through the Senate and back into the House, where they are still voting on a resolution, whether or not it can make its way to a full floor vote. That vote's been open for about 2 hours, which is unusual, so to speak, but we'll watch that here during the show. Gold, but silver and copper more so breakout, and a mixed day for the dollar, though good news for Ilya and his short British pound position. Guys, we started off with the day with a market that was looking a little bit weaker, but as the session goes on, stocks firm up. Thomas, I already had a chance to speak with you earlier, so Ilya, before we hand the mic back to Thomas, give us your quick 1 minute rundown on this equity market move on this NFP eve.
I mean, probably the most interesting thing here is just the market's sort of autopilot disposition here. It doesn't look like there was anything that really nudged them this way or that in particular. I mean, ADP came, nobody really paid attention. The trade deal with Vietnam, okay, yes, but it didn't really move the overall index in a decisive sort of this is the news kind of way. We're basically sitting at the highs for the year and almost like waiting for what the second half theme is going to present itself to be. And in that sense, the jobs data is, of course, very interesting. So it's almost like the markets are at a kind of starting line to kick off January again. We had our spook, sentiment has recovered, let's try again. And the NFP data is perhaps the first sort of opportunity to really get some second half allocations moving. Obviously, we can see volumes here are very, very low, so it's not like money is rushing to position for the next quarter or two. And so we then end up with this being kind of the first big tell. And as we've been talking about, the disconnect between stock and bond markets is what I'm most interested in, because the bond market is saying that inflation expectations are down, not up, and Fed funds futures are saying the Fed is going to do 120 basis points in cuts through next year, not 75. So somebody here is wrong, and we're going to get a chance to maybe see who that is with this data.
Thomas, we firmed up here a little bit into the end of the session. We're basically going into non-farm payrolls in at least the SPX. If you're looking at SPY as well, these are all-time closing highs.
Mm-hmm.
Do you feel different than Ilya does or than I do about tomorrow's jobs report? Because it seems that Ilya and I have a bit of a disagreement about the importance of tomorrow's NFP figure.
I think it's important. I mean, like Ilya said, there's going to be a theme for the second half of the year. It's you know, the Fed's going to cut. The economy's holding up just enough to avoid a recession, but keep profit margins aloft. Trade deals are now happening. So there's some exuberance. The thing that holds me back is this light volume, but again, that's to be expected during a short holiday trading week. But positioning wise, I'm holding back. I'm long Tesla, but that's about it for equities. I'm waiting for volatility to expand, for the price to pull back, and then, getting more directional in this market for equities.
I saw an interesting stat earlier today. You mentioned sentiment. I think that's a point worth discussing. The June AAII asset allocation survey came out earlier. Just some of the top line figures here, and this is available from AAII. You can go over to their website right now. What do we notice about this? The stock and stock funds allocation is at 67.5%. That's above average. We see that bond and bond exposure is at 15.9%, which is slightly below the longer term average. And ultimately, cash is basically down 3 points. That's 16.6%. That is below the average. So to a certain extent, it makes sense. If the market was in a chase mode in, we'll call it the second half of the second quarter, trade agreement framework reached with China in Switzerland May 12th and onwards, basically, the market goes into chase mode. It still feels like we're very much positioned in chase mode. And so this, in a certain sense, it's crowded. In another sense, we know where, futures traders stand, and futures traders haven't jumped on board yet. So typically you're going to see the, exhaustion type move once everyone piles in long. Thomas, while we have you here, just a quick look at what's going on in oil prices, because you are a bit of our resident expert. Crude oil's up 2.8% today, natural gas up 1.73%. So Natty's a little bit in from when you and I spoke earlier, but crude oil has extended its gains a bit more. Was there something in the inventory data today that helped spur this on? Something tomorrow that we're looking forward to?
Yeah, it was all imports. Imports increased a lot, exports decreased. So that's why, you get this stock build. And this comes after 2 weeks of heavy declines in inventories. We're still 11% below the 5-year average for crude oil inventory when you exclude SPRs. And today we're seeing, the backwardation is strengthening between the current contract and the next month's contract. So backwardated about $1.47. That's down considerably from, a couple weeks ago, but you had the geopolitical risk premium in there. Mm-hmm. So if you're looking at it from the beginning of the year, we were almost out of backwardation in February. And then all the way until May, we traded around 60, 70 cents. And then this Iran thing really jumped us into a steep backwardation. And now we're still fairly elevated. So when you're this backwardated in the oil market, it's kind of, some people see it as a proxy for physical demand. And that's kind of what you're seeing in the US with stocks 11% below the 5-year average. You got, earlier in the year, I thought there was an artificial, cap on prices from OPEC since they'd increased production. And perhaps we haven't hit that yet, if we will. We're only trading at 67. Myself, I'm long. I have the put spread on in oil at 61, 62. I'm going to keep that. And, if I was taking a position today, I'd be slightly bullish. So trading up back towards the 70 level, I think. But, a lot of this also has to do with the jobs report tomorrow. If we come in under, that's going to spook the demand side for the market and perhaps push us back down.
Ilya, was there anything that you flagged in today's trading about oil, or is this simply just, as Thomas says, a story of inventories? Because when I look at the scope of today's data, I don't necessarily see anything super inspiring. even if I would suggest the market does have a growth tilt. Banks, industrials, consumer discretionary, copper, silver, the dollar fades over the session.
Mm-hmm.
It felt growthy. Felt like oil had enough of a reason to be there.
I mean, sure, but I think when you look at the price action, I think to Thomas's point, you got a kind of nudge with these inventory numbers, and that was really sort of intraday the catalyst. Now, it's always difficult to unpick, like, did the market want to go higher and didn't because it obviously knows that on the calendar is this event risk, and it's going to wait to get to the other side of the event risk before doing what it was already going to do, just in case the number is something way off sides? Or was it the number that motivated the reaction? Ultimately, it doesn't matter. The market is telling you where it wants to go. But the trigger seemed to be these inventory numbers. And to Thomas's point, crude imports absolutely surged. I mean, we're looking at 2.9 million barrels, almost 3. That's, I mean, we'd have to go back 2 years or so to see something comparable. So perhaps there is a story of demand here, but not exactly even the numbers. I mean, obviously, you wouldn't expect if you'd get a 3.8 million barrel increase in overall stocks that prices would go up. But after the kind of declines that we've seen, you take that in context. In fact, the Challenger job cuts data was kind of a similar story today. We had the smallest number of job cuts for any month so far this year. But also 2025 has had the most job cuts since 2020. Mm-hmm. And that's because they were all stuck in the first quarter, mainly in February and March. So to kind of see normalization at the headline of the inventory numbers, that's contextual. But that imports number is seemingly speaking to significant demand because that's new. That's offsides. So maybe there's something here, and certainly after the kind of sell-off that crude oil has had, maybe it makes sense that sort of the path of least resistance is a bounce. But I agree that tomorrow's jobs report is a downside risk for this. So I'm not looking to be a buyer. I think the story that the bond market is telling us, the story that the disappointments in U.S. economic data has been telling us, all of that points to everybody but equities having sniffed out some kind of an economic downturn. And that's not a great environment for crude. It's just a matter of when the evidence appears, it seems like. So, and some of it has appeared already. So I think I would rather be using this bounce as an opportunity to sell, rather, not yet, but once it appears to peter out, rather than something I'm going to be chasing higher.
We're going to take a quick break here. After this, we're going to swap Thomas out, bring Dylan in. I'm going to make a case for why the oil move is why bonds are weaker today. Quick 90-second break. We'll be back here on Tasty Live.
Forbes called us best online for options trading. Investopedia, best for options trading, period. With stockbrokers.com, we're number one for options and futures trading. The Motley Fool really likes us. And so does Business Insider. So what else can we say other than boom? Trade like a trader. Tasty Trade. Make your move.
Dear Karen, thank you so much for the relationship advice. Of course, since you met your husband in high school, I should obviously just go back to high school. Can't wait to win the Nobel Prize for my development of a time machine. Signed, Regina.
Sometimes it feels good to get smart. Get even smarter with live trading insights and some live taunting.
You're mistaking me for someone who cares.
From the smart mouths at tastylive.
If you missed the live show, here's our cherry on top weekly recap.
Question for you guys.
Yes.
Vanetta this morning was giving me a little flack. It was lighthearted. She meant well.
Okay.
For my particular baby face.
Yes. You are young.
Just
young
question for you guys, because I look up to you both. How much of your success, I don't know, financially with the ladies, do you attribute to having facial hair? Is it something I should work on actively?
Ooh. See, the thing, I can hear John laughing out there. See, the thing is that, you either have it or you don't have it. And
all right.
You just don't.
I could put together a pretty gnarly neck beard.
It's a manly thing. But
the last time I shaved my face, it was to dress up as Sting for Halloween. Like Sting the wrestler.
every time I leave Tasty, I miss it. Even like when I go home after work, I think about Tasty. I'm like, I wish I was really in the office.
No, you don't.
I don't. That's it.
You just went abroad. Were you able?
Yes.
Were you able to just fully disconnect?
Fully.
Yeah.
We saw several artisans, but the sword maker. 3 months to make a sword.
Yeah.
That's
when
one of
does
the
yours
unique-
get delivered? You didn't do the sword?
50 grand. And there's
but that's,
and a 2-year wait list.
It's a couple spoons.
Yeah, that's, come on.
I'm going to Rockford for a wedding. It's going to be a very fun wedding.
Your friend that's getting married or is your girlfriend's friend?
Girlfriend's friend.
Do you want your girl to catch the bouquet?
No. That never ends well. Like in movies, that happens. The guy's like,
Get the full scoop by checking out the archives at tastylive.com.
You can get up to $4,000 when you...
Got friends? Get $250. We'll give you a bonus for each qualified person you refer to Tasty Trade. So spread the word and earn rewards. Terms and conditions apply.
We're back. You're watching Overtime on Tasty Live. I'm Chris Vecchio in New York, Ilya Spivak in San Francisco. Dylan Radigan now in from Milan. Before the break, we were talking about how oil prices were pushing up today on the back of these inventory figures. I want to make the argument Ilya, the rolling 24-hour correlation, looking on a 1-hour basis between bonds and oil prices. Yesterday at their high, when bonds were trading up at 116.03, the rolling 24-hour correlation between bonds and oil was literally zero, flat. Today at the lows, that correlation between oil and bonds was negative 0.79 on a rolling 24-hour basis. And that makes sense from our fundamental macro view. Higher oil prices, particularly those that climb sharply in a quick period of time, can have a shock effect, if you will, into inflation expectations at the long end of the curve. Mm-hmm. So do we make too much of this? I see a potentially bearish looking set of candlesticks here. I'm not too concerned because we do have that jobs report tomorrow. You and I have talked jobs for a quick minute here, though. Dylan, now that you're on with us, what are you thinking about the jobs report tomorrow? Do you care about it? Does the market care about it? Should we care about it?
I mean, I think this particular jobs report, it seems like, on the margins less than other jobs reports. But you can never, I said this earlier this week, you can never dismiss a jobs report. It is, for my money, the most significant piece of economic data that exists in the United States, full stop. And, I think what we have going for us right now is that people seem to have a pretty good comfort level with whatever the number is going to be relative to expectations. But you can never rule out the possibility that you're going to get a jobs number that's wild. I think the risk right now is that the jobs number is materially weaker than expected because of CEO uncertainty about budgets, because of all the tariff cockamamie in the first half of the year. that may have contributed to a slowdown in hiring. I mean, this is totally conjecture. And so there may be a world where the jobs number comes in well below expectations, if only because of the lack of confidence in budgeting, because of the lack of confidence in the cost of operations, because of the lack of certainty of the tariff. Now, obviously, nothing that I just said is not within the totality of all the integrated analysis of expectations. So one would presume that whatever the forecast here is here for the number, that forecast has accounted for that uncertainty. But at the same time, there's a reasonable chance it could be wrong.
The forecast actually is the number that we should pay attention to. Ilya, this is not a great number. It's basically the break-even rate for jobs growth in the U.S., expecting 100. And I just want to make sure, is that right? That can't be.
I think it's 110.
Okay, yeah, it's 110,000.
That'd be the lowest in 8 months if we hit it on the figure.
Which is interesting because at 110,000 jobs, that does not keep the unemployment rate in check over the next 12 months. But then again, the expectation for tomorrow is to see the unemployment rate rise to 4.3%. I have to say that does not concern me in the slightest, because the last month's unemployment rate was 4.244%. And that didn't get rounded up, but if it was 4.245%, it would have been 4.25% and then 4.3% already. So a 1,000th increase in the decimal, okay, that's the line between 4.2 and 4.3 as of last month. So seeing a slight tick up here is not a shock. But when you get to 110K, we're starting to get into the zone where jobs growth may be at a place where it's not necessarily replacement level, where you're going to get a little bit more pressure on the labor market moving forward. If we think that the second half of the year has to be defined by good news, is this good news that we're getting jobs growth, but it happens to be much weaker than we need to sustain the unemployment rate at current levels?
Well, this is the key question, right? Because I'm going to say this until I'm blue in the face until this actually corrects, but there is a huge disparity between what the Fed is saying about the economy and what the markets are saying. And somebody is wrong. And what the markets are saying is that there's not an inflation concern because the break-even rates in the bond market are back to basically the April lows. And Fed funds futures are saying the Fed is going to do 120 basis points in cuts between now and the end of next year, which is about 50 basis points more than what the Fed is saying. So unless you think it's in the post-May 2026 period, because the markets think, Powell's term is going to end and the president's going to put some lackey in there to cut rates, no, that's not the way that the markets are pricing this out. It's fairly even spread over next year. So you look at this and you go, okay, what is it that the bond market sees? Why aren't they concerned about inflation? Why are they basically telling the Fed, you're not doing enough based on what you're saying, you're going to end up doing more? That speaks to some kind of an economic downturn that the market is envisioning. And although the economy has definitely taken a step lower versus where it was at this time last year and all through the second half of last year, it's not like coming apart or anything. And so Powell's argument actually sounds relatively reasonable. Look, I have a jobless rate, 4.2, 4.3%, and doesn't actually matter. By history's standard, it's not that high. In fact, it's not high at all. Inflation is at 2.4%. Looking at latest CPI, that's not anything crazy. So why would it make sense to get concerned? Well, in looking at Powell's argument at face value, it's very reasonable. Why jump on rates now? Why do anything? The economy is fine. Why not wait and see? But the markets are very clearly saying, no, that's incorrect. So in that sense, you get a soft jobs number and the market sounds right. Is that a source of optimism? Or is that optimism already all in the market because the market is already tilting to pricing all of this out? Is this good confirmation? I suspect not.
I don't know if you guys noticed today, but the anti-fiat cohort of assets did pretty well. Silver prices here continue to hug the October and March highs, riding that 1 month moving average. They're starting to potentially perk up. But my interest is in what's happening with the cryptocurrencies here, because Bitcoin, very quietly, you only see it in the futures market, but we put in this bullish engulfing bar. We were below yesterday's low. We closed above yesterday's high, where we've been talking about having interest in IBIT because of the technical setup here. That's starting to look like a bit of a breakout right now. And I don't hear anyone talking about crypto. Dylan, the top story right now on Fox Business News and CNBC is about how the House GOP is fighting with itself to figure out what they can do with Trump's bill. And it seems like the fighting is about just how big the deficit's going to be, right? There's no more earnest attempt at actually producing a budget surplus. If who's going to solve this then, right? Like, it isn't, to take a step back, big picture on Bitcoin, the dollar's being diluted. The U.S. is on an unsustainable debt and deficit trajectory. Here you have Elon Musk and Doge and Donald Trump coming in saying, we're going to fix it, and this is the best thing that we can produce. Who's going to fix it then? Who's going to have a mandate to fix it if Donald Trump and Elon Musk didn't? Why shouldn't Bitcoin be trading higher?
So let me just make sure I'm tracking the logic. You're saying the last hope for non-abusively spendacious American government was the Trump-Musk operation. Is that the first assumption?
I think that is the understanding for a broad swath of the American public that's engaged politically.
So the last hope for sort of to get it under control was a Trump-Muskian sort of Doge-driven intervention.
Let's put this to the chat and I'll read it back. For those people that voted for Trump, right? Did you think that like fiscal restraint was part of the message, right? Was that part of the deal? Right. I mean, that was my perception.
But I think that's a reasonable to high level sort of assumption.
Okay.
And now you're saying, well, obviously that's off the table because you got maniac deficit. You'd think a Democrat was president looking at a budget like this in terms of the deficits and the recklessness and the madness and the absurdity and the preposterousness.
A former Democrat is president. Go on.
Therefore, you're saying that this then leaves the dollar and the sort of traditional currencies more vulnerable than ever to the fruitbirdery that is the government. Fair?
Fair.
Thus, non-fiat assets, i.e. Bitcoin, should be more valuable.
Correct.
Mm-hmm. What about the fact that Bitcoin in and of itself is its own freestanding fruit bird, and that its very existence is its own uncorrelated exercise in preposterity, or preposterousness might be a more appropriate. I guess to all jokes aside, I'm not sure that my jokes are particularly jokey. It's not clear to me that Bitcoin is any more credible than any other asset. All assets are up, and I think that the whole story is in the U.S. dollar. I think that whatever's going on here, that the real liabilities of everything that's happening is in the continued weakening of the most fundamental most fundamental financial asset on earth, which is the U.S. dollar. And so isn't that
the Bitcoin story then? Right? Like, forget Bitcoin.
It was.
It's the everything story.
How's it quoted though? BTC/USD.
But so that's the whole thing. That's everything.
Even if it's fruit batty, right?
Listen,
Dylan?
They don't call Bitcoin a fruit bird for nothing.
It could be fruit birdier. That's what I'm saying. Like, Bitcoin could be a fruit bird, but the U.S. dollar could be fruit birdier at the moment. And if you think of it like a currency, Ilya, everything's relative. It's just a matter of relativity.
There is certainly a lot to be said for the immense shellacking that the U.S. dollar has faced as being a reason for all things not the U.S. dollar to go up. But given sort of my general conclusion that Bitcoin's fruit birdery is entirely undesirable, I would rather own the euro or the pound or some other liquid,
or the Aussie
reasonable
dollar.
Yeah, some sort of other dollar alternative. And that's the way I've been expressing that view all year, is basically buying major currencies, all of them, at one point or another. I wonder now if the dollar isn't ready to make a turn because it's been getting absolutely whacked all year long with no respite. You'll notice that whereas both the dollar and bonds and stocks kind of had a uniform sell America terrible crescendo in early April, and bonds have obviously been slower to come back than stocks, but they've both come back. The dollar has not. So in my mind, you're starting to get to a place, maybe, where the dollar is again becoming a risk-on, risk-off type of asset. You're kind of seeing it in the divergence of the way in the way that the dollar is behaving against different currencies. For example, I am right now both long and short against different currencies. I'm long the Aussie, I'm short the pound. Both are working. And that gives you a sort of risk-on, risk-off dynamic within the dollar itself. So my sense is that if stocks give way here, the dollar is going to rally. Not because its yield profile is improving, but because everything we just saw in the second quarter was about this idea that maybe we're going to crash the dollar-based economic order, and then coming to the conclusion that actually, no, we're not. And so if that's the overall conclusion, I don't really want to be long any highly volatile, high beta, jumpy dollar alternatives. I'm happy with the Aussie dollar as a way to get a little bit of a risk on tilt somewhere, since I'm not going to do it in stocks, and see what happens. But my sense is that the dollar is getting ready for a rebound of some sort.
I don't care if this is fake news. Apparently, there's a report from Notice, which says that during a meeting, Trump told members that they want to win their re-election, they shouldn't touch Medicaid, Medicare, and Social Security, to which one Republican in House leadership says, but we're touching Medicaid in this bill. I don't even know if this bill passes, but if it doesn't, right, like some form of fashion is something is going to pass, right? So, but Dylan, you say
a bill will pass.
Ethereum's up 8.15%. If this is fruit birdery, right? Don't we just have to learn to embrace it and love the bomb? Go Dr. Strangelove on this thing. If pigs are going to fly like Ethereum, it's up 8.21% today. Rather be amoral and rich than smart and poor, as you said yesterday?
Yeah, I mean, I said it yesterday. I mean, I do believe exactly that. You know, I think the only question is sort of where to get the best bang for your buck. Is it in Bitcoin? Is it in Ethereum? Is it in the NASDAQ? Is it in the Mag 7? Is it in the financials? You know, that's I think the most interesting discussion right now from a purely trading perspective is not up or down or whatever. It's of the things that are going to go up, what has the best risk reward, the highest probability to go up the most relative to the lowest probability to lose value. And I think that's where the most interesting conversation is at the moment. And I don't honestly know what the answer to that question is.
Highly levered coal companies that are going to get a ridiculous amount of tax cuts. Wouldn't that be something that's really crap that hasn't performed well? What am I thinking of here? Here's BTU, Peabody Energy, looking like it's carving out a bit of a bottom. This was just in November after the election, by the way, a $30 stock. It's currently trading at $14.68. Alliance Resource Partners, again, after the election hits a high of 29.44, so it's not terribly depressed, but about 10% weaker. Arch Resources, this has a big rebound today as well, right after the election. Actually, what's going on here with this chart? Is this purchased out? This was bought out. Oh, I didn't realize it stopped trading. AMR, this is up 13.3% today. But Dylan, that's kind of the point here. Where the big outperformance in the market as this bill's coming on, you talk about stuff being pumped up, if it's Bitcoin or whatever. Maybe the play is just these beaten down energy companies that have low valuations that now are going to have the spigot opened up for them. I mean, AMR here, look at this thing. This was trading back in the what? 240s around the election. It's now $120 stock. It's taken a 50% haircut. Why not pump again? I think we should take a look at this, Ilya.
I mean,
we're going to do the crappy things. Let's do the crappy things.
In my mind, it's to want to go do crappy things makes sense.
Not wanting to do them, feeling compelled and have to do
feeling compelled to do crappy things, sure, is a sort of bet on the slow and steady melt up generally continuing, because it is a bet on overall risk appetite being something that broadly survives. Otherwise, people aren't going to be in these names. We're going to a correlation 1 sell-off, and that's it. So for me, what makes this something that I'm not compelled to do isn't that it's not a good idea. It's the timeline. Because to me, the disparity between what stock markets are doing and what bond markets are showing suggests that there's some kind of a reckoning here that's going to become a defining theme for the second half of the year. We just spent the first half of the year basically on a single yo-yo bounce. We bounced down, we bounced up. We're where we started. It's January for all the S&P 500 cares. And so the question now, I think, is, okay, that was fun. What's going to be the theme for the second half of the year? And that disparity between stocks and bonds seems like the place where something needs to click, either this way or that. And then the markets will know sort of generally where they're going. Because a lot of what we're doing here is we're talking about things that are, for the most part, known. I don't think, by the way, that the markets went into this year expecting this administration to be restrictive. I think very clearly there were absolutely no pretensions to the fact that both candidates in this election are expansionists, that one of them wanted to raise the deficit by cutting taxes, and the other one wanted to raise the deficits by increasing spending. I don't think that was lost on anyone whatsoever.
Line goes up either way.
Right. So I don't think there's anything shocking in this legislation in the sense that it increases the deficit or that Doge was a farce or that, I mean, I think the markets knew all of these things. And so that we have this disparity between the biggest pockets of liquidity in U.S. markets seems to suggest that some kind of a reckoning needs to come. It doesn't have to be negative, but some sort of a thing needs to get resolved for markets to get on page and define what's going to be the second half of the year in general terms, to set the lens for it, much like the Fed sets the lens for policy once a year at Jackson Hole, incidentally coming up in August. So for me, I think that the disparity resolves in lower stocks and higher bonds and a dollar that bounces and then sells off again, and gold prices that go higher. But who knows? What I'm not prepared.
I got a second half of the year for you right here, Elliot.
Yeah. What I'm not
1998, 1999 again.
I mean, maybe. What I'm not prepared to do is to say that we can with certainty say that at this point right here, we know the way that it's going to resolve, and we know that the environment for overall risk-taking will be good. If the environment for overall risk-taking isn't good, picking names here and there isn't going to matter.
There's just a part of me, and I think, I was talking with Mike Butler earlier today about this, how it's just like the season of like everything kind of feels fake. It's just the season of chase. Those weren't his exact words, but he used stronger language, and I don't want to put him on the spot like this. So we'll just leave it there. That captured the spirit. People are underinvested still. Stock traders are still short. We know that asset allocation people have become very bullish, but those are long-term fund managers. I'm talking about traders, speculators who are trading futures for simply the sake of trading futures to make money. And that lot of folks have been holding short this entire way. We're going to get on the other side of July 4th here, Dylan. Actually on this chart, this was produced on June 24th, so that puts us basically here on our chart. So let's get a few more days of chop. We could follow this thing into the August, September. We don't have a big pullback, but if we're going to go nuts, why not just lean all the way in? Why not just embrace the crazy? It's going to be like the dot-com bubble. We're going to do tax cuts. We're going to do SALT deductions for the wealthy so that they can take more of their hard-earned money to put it back into the stock market. We're going to get cheap energy because we're going to burn all the coal.
No, I get it, but you're saying just buy the S&P and keep it simple, stupid. Is that what you're going with here?
I'm compelled to say that because I'm reminded of some of the research we've shown in the past about kind of what trading style is most efficacious depending upon the volatility regime you find yourself in. And just for the sake of that study, it was when you're at 15 or below in the stock market, the best thing to do, both in terms of average daily returns and standard deviation of daily returns, would be to just simply get long stocks in some form or function, buying the index, buying an at-the-money call spread. And right now, the front month expiration has dipped into 14.97. We're below 15. We're back in that territory where you just kind of got to be a numbskull knuckle dragger like I was for so long last year, like you were. We were all for some time last year. It was just like, hey, this thing's floating up. I'm just going to buy the market and not think too hard about it. I know it feels dumb and there's so much noise out there, but Dylan, I think you made a really good point the other day. If you overthink and you react too much to the news, you're gonna drown. And you got to just kind of look at what's on front of you in the screen. And not that nothing matters, but there's incentive.
But just go with the math. If there's more money available, and especially more money available to the wealthy, it goes into stocks and real estate. Full stop.
Goes into stocks and real estate. Full stop.
Maybe some art. I don't know. It's pretty. Maybe a few diamonds.
Art. Diamonds are such bad business these days because they can make them handy now.
Some jewels for the lucky lady.
Maybe a new car. I was able to just negotiate a really good deal on a new car. Got them got them to drop down $100 a month by playing 3 different dealers off of each other. Yeah, I feel pretty good about that.
Congratulations. I guess the only thing is the sort of counter argument to this whole thing, for at least from my perspective, is too late, pal. Like the stock market's already at records. No surprise here. Everybody thought the bill was going to pass. They priced it in a while ago. If anything, by the time this thing clears the finish line, it's sell the news, because the back end of the sugar high is a social and currency catastrophe.
I was under the other impression, or different mind, that the non-farm payrolls report would actually be important tomorrow, because if we started to tilt into this territory where private sector payroll growth, and even if it's ADP and we dunk on it, if it's going to be bounding around in negative territory, it shifts the focus on, can the Fed cut because inflation's sticky, to it's a different type of Fed mistake, right? A Fed misjudging inflation for not being as warm is not as bad as a Fed not understanding that the labor market is weak. So tomorrow's jobs report, right? If we then go back to some of the numbers we ran yesterday, there's 8 occurrences in history in which the market was down by 8% or more at one point year to date, only to finish the first half in the green. The only 2 times where the second half of the year didn't produce gains, 1958 and 1990, years that had recessions come into the back half of the year. But all the other times when you have that V-shaped rebound in the first half and there's no recession, the market stays up. So tomorrow's jobs report, right? If it is a soft number, if it's a negative number, I think that scares the hell out of the stock market, because all of a sudden that 23% chance of a Fed rate cut, that's going to get pulled forward. And it's like the Fed may have to cut rates for recession reasons, because can they afford to go all of July, all of August, into September without providing support? Because if they don't, you're basically going, from now until the next September cut is basically a quarter of the 20% of the year. So you're going to run off the clock 20% of the year if you don't cut in July. And that's why we also have to entertain the September 50 basis point cut, because they could really feel like they're late if things percolate. That's one of the reasons why I'm not worried about bonds either.
Yeah, I mean, this is an important part of this. It isn't just that since the June meeting, the markets have been baking out more rate cuts for next year. The probabilities for this year, for July, for September, for October, have become more dovish. The market is very pointedly looking at the Fed and going, you know that thing you said? No.
No. Well, that's why I'm not so worried about bonds tomorrow, because we know the long-term research shows that bonds go best places to hide during a recession. So if it's an exceedingly weak jobs report tomorrow for whatever reason, the metals should be on, decent enough ground. Copper probably not so much, but the metal should be on decent enough ground. And then I would think that bonds are going to be on decent enough ground there moving forward. Yeah. Dylan, I saw a headline today, because this is technically the last overtime episode of the week. A quick programming note. Tomorrow there's no afternoon Tasty Live programming, so we'll get through non-farm payrolls. You'll have Tom and Tony. You'll run into noon Eastern, and then that's it. There's no futures power hour, no overtime. Dylan, this report makes me feel like either I'm a total idiot or, I don't know, maybe there's a great opportunity around the corner. AI virtual personality YouTubers or VTubers are earning millions. Apparently, there's a few of these folks with millions of subscribers. Folks, what are we doing wrong here that we don't have millions of subscribers, but some AI, CGI folks do?
Novelty, baby.
Dylan, is this one of the flags? Microsoft laying off 9,000 people with no intent to replace them because AI can do all the work. Content creators quickly becoming AI. When should the three of us start to worry?
I don't know that. So here's my thought. Pretty soon, the most valuable thing of the world is going to be live in-person interaction of all kind. Because as AI takes over, I believe the desirability and interest that anybody's going to have in non-in-person content is going to collapse, because people are not going to be able to tell the difference between us talking as we are now in a non-AI form and an AI version of us or of anyone. And so I think it's less about the future of content in the digital form, although I think that's relevant. I'm less concerned about our future or the future of those who sort of do content or entertainment for a living. I think that it's a massive opportunity for all live events. So maybe our future is where we are gathering people together in person, as Tasty already does. But I think that the number one shift here in terms of increase in value for live humans is going to be any person-to-person interaction. And that to me is more certain than the uncertainty of whatever the variable is of, sort of the decay in trust in non-in-person content, because of the fact that basically all news pretty soon will be fake news.
That's so interesting that you put it that way. I've had that same thought independently when talking with people. What's the best way to build off trust with individuals? And it's not by checking the boxes and sharing the same values like online. Although, and I think actually the internet has created these insular communities before everyone has their kooky view, but it's only you, and you say it to your neighbors or the people on the street, and chances are you don't find anyone else that shares that very niche interest or perspective. Now you could find thousands, millions of people who share that same niche view, but that handshake, talking to people in person, looking them in the face, right? I know this person's real. They're not just a construct on camera, which I suppose is a good pitch for the tastylive.com/events page. We're in person quite frequently. Ilya, yes. Before you go into macro money here, give us a brief preview of what you're discussing today.
Not surprisingly, I'm going to be doing a deep dive on the jobs report and sort of how the tea leaves are laid out before the numbers come out, and really why this matters, and sort of showing the disparity in markets and what that might mean, sort of where we might be off sides if there is regime change macro-wise for the second half of the year. Because it does look like the first half of the year had the theme of, wait, this is not the Trump presidency we signed up for. Oh my God, no, wait, it's still okay. And the theme for the next half of the year may well be, right, the dust has settled, where's the economy? And if that's the shift, this jobs data may very well be a crucial first step.
You can catch Ilya immediately after overtime. He's on Macro Money, Monday through Thursdays here on Tasty Live, 5 p.m. Eastern. I'll be back later on as well with Victor Jones for The Price of Truth, 6 p.m. Eastern, so be sure to tune in and stick around for Tasty at Night. But with that, for Ilya Spivak and Dylan Radigan, I've been Chris Vecchio. We'll catch you all next week on Overtime next Monday. Good luck trading until then. Stick around for the break because Ilya's back with Macro Money shortly.
See you there, everybody.
Forbes called us best online for options trading. Investopedia, best for options trading, period. With stockbrokers.com, we're number one for options and futures trading. The Motley Fool really likes us. And so does Business Insider. So what else can we say other than boom? Trade like a trader. Tasty Trade. Make your move.
Dear Karen, thank you so much for the relationship advice. Of course, since you met your husband in high school, I should obviously just go back to high school. Can't wait to win the Nobel Prize for my development of a time machine. Signed, Regina.
Sometimes it feels good to get smart. Get even smarter with live trading insights and some live taunting.
You're mistaking me for someone who cares.
From the smart mouths at Tasty Live.
If you missed the live show, here's our cherry on top weekly recap.
Question for you guys.
Yes.
Vanetta this morning was giving me a little flack. It was lighthearted. She meant well.
Okay.
For my particular baby face.
Yes. You are
just question for you guys, because I look up to you both. How much of your success, I don't know, financially with the ladies, do you attribute to having facial hair? Is it something I should work on actively?
Ooh. See, the thing, I can hear John laughing out there. See, the thing is that, you either have it or you don't have it. And
all right.
You just don't.
I could put together a pretty gnarly neck beard.
It's a manly thing. But
The last time I shaved my face, it was to dress up as Sting for Halloween. Like Sting the wrestler.
every time I leave Tasty, I miss it. Even like when I go home after work, I think about Tasty. I'm like, I wish I was really in the office.
No, you don't.
I don't.
That's it. You just went abroad. Were you able to just fully disconnect?
Fully.
Yeah.
We saw several artisans, but the sword maker. 3 months to make a sword.
Yeah.
That's
when
what
does yours get delivered?
50,
You didn't do the sword?
50 grand. And
but that's,
and a 2-year wait list.
It's a couple spoons.
Yeah, that's, come on.
Going to Rockford for a wedding. It's going to be a very fun wedding.
Your friend that's getting married, or is it your girlfriend's friend?
Girlfriend's friend.
Do you want your girl to catch the bouquet?
No. That never ends well. Like in movies, that happens. The guy's like,
Get the full scoop by checking out the archives at tastylive.com.
You can get up to $4,000 when you open and fund a new account with Tasty Trade. That's 4,000 buckaroos, 4,000 bills, 4 large, 4K, 4 grand. Get on the platform for traders who just want to trade. Tasty Trade. Make your move. The market doesn't stop. So why should you? Diversify your portfolio with stocks, options, futures, crypto, and more from Tasty Trade. Focus on the markets that matter to you. See the odds before you trade using curve analysis, IV rank, and more tools. Get industry insights that help you find your next trade right where you need it. Tasty Trade. Download today.
Eddie in Texas, what's up?
I'm trying to determine whether or not I should actually feel experienced enough to grow my account. I've been trading for about a year and a half, done all the homework. I'm not sure if it's just a market that I got lucky in the past 2 months.
Like, how many trades have you made?
This year so far, about 100.
Yeah, so if you've made 100 trades and it's working for you, then that's not luck. No. That's not getting lucky. That's being freaking smart and doing the right thing. Because you took advantage of an opportunity is not getting lucky. You made 100 trades already. Back when we started building this kind of software, an active trader made like 20 trades a year. What used to be 5 years, you've packed it into a few months. I mean, I wouldn't discount anything that you've accomplished so far at all.
All right, Mike. All right, Nick. Do you remember the first trade that you ever made in your life or in your career?
I do. It was a long call on Twitter. This is when it was a publicly traded company. It was at like $50 a share. I bought a call at 50, and the next day it rallied, I think, 11%. And it was like the single largest bull rally in one day in Twitter, and I was like, this is the easiest thing I've ever done.
Oh, I know the exact trade. So it was in Costco. I don't know the exact strike, but Costco was trading about 150-ish. This is in 2015. I sold, I believe, the 165 strike call against it because I read some article online that Walmart was going to eat their lunch. Costco, I think, went from 150 to 200 within 3 weeks of that trade. It was a massive losing trade. I learned a lot from that trade.
And you still came back?
I still came back. Yeah. I was not discouraged. I thought I was an idiot, but I was not discouraged.
The future of trading is here.
Got friends? Get $250. We'll give you a bonus for each qualified person you refer to Tasty Trade. So spread the word and earn rewards. Terms and conditions apply.
Well, it's that time of the month. We are looking down the barrel of the monthly U.S. jobs report, and there is plenty to talk about. Markets are relatively quiet here as we get into the week, and we have a generally content start, it would seem, to the second half of the year, but a defining theme is yet to emerge, and maybe this jobs data will be the catalyst. This is Ilya Spivak, head of global macro here at Tasty Live. This is Macro Money. And what we'll do here first and foremost is take a look at how we are setting up across the major markets for this data, how we came in today as we got the first days of the second half of the year, end of the third quarter, under our belts, and then see what this data might start to do to shape what comes next. Because as we've been talking about for the past several days, there is a glaring disparity that now emerges in stock and bond markets, and one way or another, it's going to resolve itself. And this data may be the beginning of how that happens. So just looking at the performance here for the day so far, Bitcoin had a nice jump, 3.9%. Crude oil, the standout, though, as far as moves outside of the realm of the usual. Crude oil having a spirited rally here after a few days of consolidation following those wild swings around the Israel-Iran conflict. And the data today on inventories, interestingly, seems to be the driver that inspired what we're looking here. The interesting thing here is that actually overall inventories for crude oil went up, but after a long period of sharp declines. So although the overall inventory number was up by 3.8 million barrels, that's after 5 months of blistering drawdown, most impressively an 11.5 million barrel drawdown in the middle of June. So with this sort of an aggressive 5-week run, it's not surprising to see a little bit of a build, but the standout was a jump in crude oil imports that seemed to speak to significant demand, an increase of almost 3 million barrels. That would be the largest rise since August of 2023. So perhaps a sign of improving energy demand here, and crude oil sharply higher on that. Otherwise, another slow push into the highs for the S&P 500. It continues to hover near the highs of the year and figuring out whether it has the temerity to break them. NASDAQ rebounding from yesterday's losses, now basically unchanged for the week. A little bit higher, but only very, very marginally so. Yields a little bit higher, the 10-year, the 2-year up across the board, and that might be linked with this jump in crude oil. That it's the kind of thing that tends to echo into inflation expectations and nudge up yields, and indeed that's what we're seeing here today. Gold a little bit higher, the dollar a little bit lower against its major counterparts. Gold has been attempting to stage a recovery for the past several days, as a matter of fact, and its attempts have been, for the most part, fruitful. We're looking at gold prices now that for the past 2 days have erased almost a week of downside progression last week, and at this point are maybe about 50% of the way back in the direction toward June's highs. So a spirited rebound there, perhaps in the spirit of a slightly weaker dollar, and unbothered here by the pop in yields. But of course, all of this is sort of tinkering at the margins when we consider that the week's real big macro catalyst still beckons. And that, of course, is the June jobs report. The expectation here is that we're going to get an increase of 110,000 to overall non-farm payrolls. That's a rise that would amount to the weakest in 8 months. The jobless rate seen going up to 4.3% after holding at 4.2 for quite a while. That's certainly an increase relative to history. If we consider how that stacks up over time, it's the highest since October 2021 if it happens as expected. But nevertheless, it is still quite low by historical standards. Now, an interesting bit in this story, as we sort of look at what these numbers might mean and what they might do, is what automatic data processing told us earlier today, ADP. They put out a private sector estimate of job creation. And before we sort of delve into this, it's very important to note this is not usually a good month of foreshadowing or prediction of what the official NFP numbers are going to be. So in seeing these numbers for June, we wouldn't necessarily jump and say, well, NFP is going to be that. But it does create a sense of general conditions in labor markets that set up what the risk of surprise might start to be in incoming jobs data. And what we find here, of course, is that really since the middle of last year, there has been a steady slowdown in private sector job creation. But really what made June stand out was this negative reading. So ADP told us that in June, private sector payrolls declined by 33,000. And this was actually the worst result and the first time that we've seen a negative reading, as we can witness on the chart here, since March of 2023. So not exactly a happy sign here for labor markets, and adding to a general pile of evidence suggesting that the labor market is weakening. Last week's jobless claims numbers is a 4-week average of initial claims, so first claims for unemployment benefits. We can see here we're looking at some of the highest levels here on this 4-week average in 2 years. We'd have to go back to sort of the middle of 2023 to get something comparable. When we look at continuing claims, it's not much of a happier story. This is sort of the next iteration of claims, and as this rises, you get the sense that people are having a hard time finding a job once they lose one, and so they're extending benefits. Continuing claims now at the highest level since November 2021. Now, a slight bright spot in this equation has been a piece of data this week on job cuts, but it's only a bit encouraging, if encouraging at all. So we did get what was the smallest number for reported job cuts at around 48,000 so far this year. And this comes to us from Challenger, Gray and Christmas, which is a consultancy. But that's after a very dramatic spike earlier in the year. You can see here, this jump in layoffs was, in fact, the largest such thing since back at the onset of COVID. And we're looking for the year as a whole at 744,308 job cuts, which is the most, indeed, since 2020. So it is interesting, of course, to see moderation here, but what this is a return to trend rather than anything particularly encouraging. And then, of course, as we talked about yesterday, the ISM manufacturing survey gave us the fastest pace of contraction on the employment side in 3 months. As ever, this is in the logic of PMIs. So above 50 is growth, 50 is neutral, below 50 is contraction. The further you go below 50, the faster the contraction. The further you go above 50, the faster the growth. And so what we ended up seeing was a 4th consecutive month of contraction in the manufacturing sector against a backdrop of surging prices, falling new orders, and falling employment. So giving us that sense of a stagflation type of data set. Now, obviously, we're not seeing stagflation realized in the overall economy, but these kinds of numbers, if only just looking at the employment component, certainly suggest that the labor market appears to be under duress. And this kind of slow and gradual descent in the amplitude of job gains may finally be reaching some kind of a point of acceleration. Now, we do have, in addition to this jobs data, the service sector part of the ISM report. It is expected to give us basically steady growth, 50.5, so just a touch above total standstill. And when we compare that with what we've just seen, this overall 49 on the manufacturing, we probably have something that levels out to a composite of maybe 50 or just a hair above if we get the numbers as expected. So we'd be looking for an economy that's essentially at standstill, barring some sort of upside surprise. And on the jobs front, we can see that in the prior month, jobs slightly by a narrow margin returned to growth in services. We'll see if that momentum holds up, but the general trend since the post-COVID catch-up peak has been toward slower and slower job creation, and increasingly more and more time being spent sub 50, that is to say, both sectors losing jobs. Now, as we've seen over the past weeks, really going into the beginning of June, U.S. economic data has pointedly diverged in a negative direction from the global pack. This is Citigroup data on economic surprises. And we can see here that increasingly U.S. economic data is faltering relative to forecasts. Here's the zero line, which would amount to the data basically coming in line with expectations. And when we look at what's been happening essentially since late May, is this persistent weakening in data outcomes relative to those expectations, implying that basically analysts' models are off, and they're off in a rosy direction, notwithstanding some one-off jumps like the durable goods orders report last week. Moreover, we can see that the weakness in the overall global index is mainly rooted in the U.S., because we can see here that it is the G10 set that's pulling the global average lower as emerging markets hold up. And within that G10 set, it's the US that's pulling things lower and Europe that's holding up well. So while the US economy may be in absolute terms in a much better growth sort of environment than is happening for the other major economies, Europe is effectively at standstill, and so is China, as we just saw from PMI data over the weekend. So we're looking at a situation where the U.S. is certainly the brightest of a dim bunch as far as economic growth is concerned here amongst the major economies, but the direction of travel is pointedly more negative. And so it seems like what's occurring is the U.S. is converging on weakness elsewhere, rather than weakness elsewhere converging on strength in the U.S. We see a similar story in this Atlanta Fed GDP Now model, where, never mind the level, the story here seems to be that, again, since about late May, the tone of the data going into this model to inform where it's going has been decidedly negative, which is why the model is getting revised lower as this data comes in contact with the overall basket here. So never mind the fact that there is a vast disparity of expectations for what fourth quarter growth may actually, or second quarter growth rather, may actually look like. The range is unusually wide, from 0 to almost 4%. We're still far enough away from this data that these things don't actually matter all that much and will even out. But more importantly, the data informing the model is telling us the general trajectory for data flow in the US is toward weakness. And this speaks to the disparity we've been eyeing in bond markets. This is what we mentioned at the top, is this disconnect between what's going on in stocks and what the bonds are saying. So if we back up here to mid-February, we can see that stock markets start to sell off around when business and consumer confidence surveys start to say that the rollout of the tariff regime from the White House is spooking people and hurting demand and weighing on economic growth dynamics. We see at the same time that the inflation expectations baked into the bond market are falling with stocks, as if to say, okay, we have an economic slowdown, earnings outlook is worse, growth outlook is worse, so inflation outlook is lower. This is a deceleration in growth writ large. Then we have the crescendo that was early April. We get Liberation Day with a bunch of very scary-looking reciprocal tariffs. The markets swoon, so do inflation rates. And then the White House starts walking back the worst of the spook. And we can see that since then, if the story from the first quarter was, oh no, the tariff rollout will hurt growth, the story for the second quarter is of divergence between what the markets think about growth and the sentiment implications of that thinking. Because clearly what stocks have done here is they've basically come back to their starting line for the year. And what we find then is that while sentiment has overwhelmingly and undeniably improved, whatever ungluing of the financial system we were worried about here has clearly faded from everybody's thinking. But the outlook on the economy remains downbeat. These inflation readings are within a hair of where they were at the worst of it. And so what we're looking at then is a market that is overwhelmingly biased in the direction of some kind of an economic downturn in the works. And not surprisingly, on that basis, the outlook for monetary policy is much more dovish if you were to ask the markets than if you looked at what is being projected by the Federal Reserve. And so what you have here is the markets basically screaming at the Fed to stop dithering, to stop trying to wait and see which side of the mandate they should worry about given this tariff shock, the inflation side or the growth side, and to get on with rate cuts. Because indeed, the last set of Fed forecasts that we had acknowledged that the outlook for GDP is cooling and the outlook for unemployment is rising, but still was worried enough about a tariff shock to inflation that it reduced the outlook on rate cuts and landed on just one rate cut next year and another one in 2027 after 50 basis points in 2025. Through the end of next year, that amounts to 75 basis points in cuts, 50 this year and another one cut next year. The contrast is obviously dramatic with what the markets themselves have on the menu. They have the Fed's 50 basis points here, and they're a little bit of the way toward pricing in a third cut, although it's not quite better than even odds yet at just 8 basis points in that direction. But for next year, the outlook is a lot more dovish. To the Fed's one cut, the market has at least 2 and leaning in the direction of a third by a narrow margin. In fact, even the outlook for the meetings still incoming this year, July, September, October, and December, since the Fed's conclave in mid-June, that outlook has become more dovish, not less, even as Fed Chair Powell has talked up all the many reasons to pause. Last week in congressional testimony and just earlier this week at the ECB Central Banking Forum in Sintra in Portugal. So this makes this jobs report critically important. If all of this leading signaling, be it from jobless claims, from ADP, from ISM, if all of this suggests that we're going to get soggy results here, then the market's speculating on what this might be policy-wise would be endorsed. It's important to note that besides the headline figures too, there are the revisions, which have been overwhelmingly negative. In fact, the average revision since the beginning of January 2023 has been negative at about 20K. But most importantly, for the past 2 months, there's been this increasing downward revision in the preceding 2 months of jobs figures, where, for example, last month, the data beat expectations by 9K, but the prior 2 months were revised down by 58K. And so on net, we ended up with 49,000 fewer jobs than we thought over the course of April, March, and February than initially reported. So as we look at what happens now with this setup, the question becomes, well, if all of this early warning finally gives us an unmistakably weak and norm-breaking jobs report, well, then the markets are right and the Fed needs to step it up. But if that's the case, then there is, in fact, an economic growth scare on the menu. What that might do is push stocks lower from their heady highs, because now that we've reset from the spook in the first half of the year, the next half may well be about, well, where is actual growth heading? Now that we're through the tariff shock, the Iran-Israel shock, and all the various kind of headline risk that we've been watching. And if that ends up being a recession, or if at least the markets are presented with the risk that it is much likelier to be recession than they are currently envisioning with the S&P 500 at its highs for the year, well, then a pullback in stocks seems like a very live risk if this jobs data misses. The US dollar, which has been beaten up all year, may well rebound, interestingly, around some sort of a haven flow, if in fact there is finally a meaningful retrenchment in sentiment. And bonds may well go higher at the long end around that same haven demand, and anticipating that the overall rate structure is going to have to be lower as the evidence supports markets, but the Fed continues to divot. And that is macro money for today. It's a shortened week here. Typically, we're here Monday through Thursday. This will be the last show for the week this week because of the holiday in the U.S. We're here on the following week, of course, as normal, Monday through Thursday, right after overtime, a show that I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and where things may go therefrom. I'll be back with Victor and Tom for First Call on Sundays, with Chris for Futures Power Hour Mondays and Fridays, back with Victor for the Price of Truth on Tuesdays, writing for the News and Insights portion of tastylive.com, and commenting at Ilya Spivak on former Twitter and Blue Sky. If you're watching on YouTube, like and subscribe. Macro Money returns next week. Happy trading.
In the world of investing, a beast lurks between the numbers. Some watch from the safety of the sidelines, but others saddle up and ride that one-ton rowdy ribeye for all he's got. If that's you, join us on Tasty Trade, named best online broker for options trading. Genius loves company.
This is Chicago. We invented the skyscraper, the Italian beef, and the standardized options market. SIBO is not only the birthplace of options, it's also where Liz and Jenny got their start. In an industry first, two female former floor traders broadcast live from the floor. Hear the sounds of live market action and feel the electricity as they present real-time trade ideas and research-backed market studies live from the SIBO's SPX pit. Watch Liz and Jenny live from the SIBO, only on Tasty Live.
The beauty of Thinkorswim was that we were different. From the name to the front-end technology was clearly what we wanted as traders. Second time around, I think we did a better job. Yes, we are known for our ability to support complex derivatives traders, but we also have the tools for somebody who's brand new who wants to come in on the first floor and work their way up to the top of the building.
Got friends? Get $250. We'll give you a bonus for each qualified person you refer to Tasty Trade. So spread the word and earn rewards. Terms and conditions apply.
The amount of time I spend interacting with our customers via email or anything else is pretty much my entire life.
To be so powerful and so valuable, and then to be that approachable, just amazing.
Where else are you going to be able to email a CEO, get response back?
But you know what? Before he even knew who I was just some idiot trying to learn how to trade. And he still would email and help me learn and everything like that.
Some people say it's nuts, some people say it's insane. You know, that's what I do.
The market doesn't stop. So why should you? Diversify your portfolio with stocks, options, futures, crypto, and more from Tasty Trade. Focus on the markets that matter to you. See the odds before you trade using curve analysis, IV rank, and more tools. Get industry insights that help you find your next trade right where you need it. Tasty Trade. Download today.
Tasty Trade has crypto, and you can trade with zero commissions. Bitcoin, Ethereum, Litecoin, and more. Diversify in one place. Crypto. We got it. We get it.
Look who's back testing. Tasty Trade now has options back testing for free. Test your trades with over 10 years of data for the most popular symbols. See how your trades would have performed in the past. Look back at profit and loss and take the guess out of guesswork. Oh, did we mention that it's free? Get back testing at Tasty Trade.
You can get up to $4,000 when you open and fund a new account with Tasty Trade. That's 4,000 buckaroos, 4,000 bills, or clams, 4,000 in dough or cheddar, not the cheesy kind. 4 large, 4K, 4 grand, which is no small thing. Open and fund a new Tasty Trade account and get on the platform for traders who just want to trade. And did we mention a bonus of up to 4,000 smackaroos? Tasty Trade. Make your move.
All right, we're back. Tasty Crypto Show. I'm Ryan Grayson. With me today, Shelly Van, and of course, Dan, who doesn't have a last name. Dan Cecilia, full strength here in the cave or the studio. How are you guys doing today?
Yeah, we're doing great. We're doing great. Bitcoin's back up, so everything's right in the world.
109.5, just about. ETH flirting with 2,600. Solana over 153. It's getting wild. We've got a ways to go, but it feels a lot better.
Sure does.
Do we know why? What's the news? What's the deal here? Is it this bill passed, or speculation on interest rate cuts, or you're the macro guy? What's do we know? We have any ideas?
I haven't seen any headlines. Maybe the chat knows. If you're not watching this on YouTube and you want to join the chat, participate, take an active role in this show, get over to YouTube, Tasty Live, pop out the chat, type some crazy shit in the chat. Let us know. I haven't seen any headlines, guys. I think when you look at, and we'll talk about the volatility kind of derived trading ranges, the 1 week, 1 standard deviation move, this is pretty normal. We've been in that low vol environment. The upside of that 1 week range is about 113. Downside, it's about 102. So we just continue to chop here, but I haven't, typically there is a catalyst. I haven't seen anything. We know there's a lot that's going on under the surface that should support higher prices over time, but I didn't see anything specifically today.
Did we take a look at the volatility? Like, we could look at the BVIV, or we could look at, I guess, what IBIT's doing as far as just, you talked about like volatility was really low, and we expected kind of somewhat of a move. So I guess it moved up to 41. It was down at 38.30. So this BVIV index.
Yeah, we are getting a little bit of a pop there, but in terms of any kind of actual catalyst, I mean, yeah, you're coming off of the lows, 39, 38, up to 42. So a nice move, as we might expect to, positive correlation here with that price movement. I don't know how well we can see this on the screen. Here's that volatility we're talking about. And if you missed the show on Monday, we had Cole Kennelly from Volmex on, went through the whole Volmex product suite, the dashboards, what they're doing over there. Very cool stuff. It's like a VIX for Bitcoin or ETH or crypto in general. So go and check that out on YouTube. Thank you. So yeah, haven't seen anything other than this though. Maybe there's maybe there's a headline, but just a bullish day in the markets,
We have one from James Bond in the chat. Happy hump day. What do you think of coin to having exposure to the Bitcoin market? Thoughts? Do you mean, what do you think of owning coin stock as a proxy for Bitcoin exposure, or coin stock owning Bitcoin?
I'm guessing it's the former, right? Is this a way to play crypto? Absolutely. Curious to get your thoughts. The way that I would approach this, or the way that I think about this, is very similar to, we'll use that digital gold analogy or the gold comparison for a second. So you've got gold. You're going to have certain market conditions that are going to support higher gold prices. I think we're in one of those environments right now. Another way to add a little bit of leverage to that or have a higher volatility position or exposure is to invest in gold miners. Now with Bitcoin, clearly you have Bitcoin miners that are publicly traded. I would look at Coinbase in a similar light. It's not a miner, obviously. Holds Bitcoin, is going to be exposed to people participating in the market, obviously through trading. They have a couple other revenue streams as well. But if you believe that there's going to be more participation as prices move higher, that generates more revenue for Coinbase, it is a proxy for that market environment. It does trade at a higher volatility. I don't know if I've got the, let's see if we can find the data on this, the overview. So we just said the volatility of Bitcoin was what, 42? If we looked at the
42,
BVIV.
42.
Yeah, so we've got a IV index right here of 66.8%. So Coinbase trades at a closer vol to like Ethereum right now. But that's how I would think about it, right? You have crypto market risk, but you also have company-specific risk in Coinbase. It's one of the few ways you can invest in a publicly traded crypto company, but it is a decent proxy, I suppose. It's going to be mostly correlated, positively correlated most of the time is what I want to say with Bitcoin prices, but not always.
Yeah. I mean, I think it's a great company to hold. If you're like, just alone from the crypto exposure, sure, but like,
Got in early, didn't you?
yeah, I was buying it in 2022, 2023. Actually, 2023 after everything kind of crashed. I didn't think the company changed at all. I thought it was, maybe there was some regulatory risk, but yeah, held it since then and it's done really well. So, but I tend to hold the actual spot tokens. Like, I don't use any of these as like proxies, because it's like, I just look at that as investing in a company, right? Like if I want to buy the token, I'll go buy the token. So, to Ryan's point, it's lower volatility to go hold spot Bitcoin, especially on on the platform. So,
Great question from James Bond.
yes,
The fourth?
the fourth.
Yes.
Where's everybody else in chat? Do we have a question for the chat?
Wake up, chat.
Yeah, wake
We got a lot to talk about today. Do you guys want to jump into a quick performance kind of update here? These prices are stale, but this is the dashboard from our midweek market update that came out a little bit later than usual. Apologies on my end there. But if you do not receive the midweek market update or the Saturday morning email newsletter next to Orange, get over to tastycrypto.com and enter your email address. We put out a decent amount of information, value, trade ideas, I think, a little bit of education here and there in the email. But looking at this really quickly, if you've been following along with the shows, you watched OTCL on Monday with the guys, we've been in a pretty quiet period here, grinding higher. Obviously, we've got Bitcoin closer to 110 right now, 108 at the time, but up only a couple percentage points week over week. Bitcoin has outperformed. Looking around the tokens that we track or that are offered through Tasty Trade, Bitcoin Cash, BCH, was outperforming for a second, but is flat. It's up 16% year to date. So is Bitcoin. Elsewhere, everything's still underperforming. It's not alt season. Bitcoin market cap dominance still closer to like 65, 66%. Volatility is low. So really not much has changed from what we've looked at over the last few weeks. But I will point out again that price momentum in terms of how we measure this via exponential moving averages, it's positive for Bitcoin. So I think that's an environment where, again, you look at the implied trading ranges via the volatility. In these periods or in these environments, you can feel a little bit more comfortable in buying the dip. Doesn't mean that it's going to work, but I would assign a higher probability to this trend continuing until we see these signals change or this breakdown. But just looking at some of the larger market cap tokens that we track, again, it's been Bitcoin over everything. ETH still kind of bearish on the daily. Solana went from bearish to neutral. XRP, same thing. So you could see this inflect higher, but I typically like to wait until those signals to give me the sign. You guys trading anything else outside of some of what we talked about already here today? What's on the watch list?
Shelly, what do you got on the watch list?
Like crypto adjacent or crypto?
Just in terms of what you're trading, yeah. Have you been active this week? I mean, it's only Wednesday, but I know you've probably been in the market.
Actually exited my HUT position a little too early.
Oh, no.
But I was profitable, so I'm not going to complain too much. But
can't go broke taking profits. Cannot go broke taking profits. But HUT 8 did just raise $220 million from Dubai bankers, so I don't know what that means, but
little capital injection. So you're out of HUT 8, the Bitcoin miner. Dan, what's on the radar?
I'm looking at this SharpLink, SBAT SharpLink thing, and I know it's not a crypto token, but it's this Ethereum treasury vehicle, which I think has been heavily covered elsewhere, but I am beginning to take a look at it because seems like it might be a good time to get in. I haven't bought, but I don't know. Just seems like an interesting play. ETH might be catching a bid here. We could see something happen with some of these treasury vehicles.
Yeah, you're seeing more and more of that. I mean, on one hand, you have more companies that are publicly disclosing positions on their balance sheet where they've added Bitcoin specifically, or more companies that are investing in Bitcoin via ETF vehicles. More institutions are coming, right? But what you're now starting to see is that those flows are making their way into Ethereum ETFs. And you're also starting to see a couple of these vehicles, as you mentioned, that are being spun up to specifically buy ETH. I've seen one that's buying BitTensor, symbol is Tau. Mm-hmm. Maybe that continues, but if you're an ETH bag holder like myself, you'll love to see it.
Yeah.
Quick look at expected ranges here. Again, vol is low, off of the lows, as we mentioned. Implied vol, as measured by BVIV or Deribit, volatility is about 40%, 42%. Realized vol is trading closer to 30, so a little bit of premium in there. IV ranks are near zero, so if you look at where is implied volatility relative to the range that it's been in over the last year, it's close to the bottom of the range. For context, if we were to see around these prices, the implied volatility of Bitcoin go back to the top of the range, close to it, let's call that about 70% implied volatility, then you're going to get closer to a $10,000 weekly move on a 1 standard deviation basis. Right now, you're looking at about 5,500, 5,700. So that move almost doubles, obviously, if implied vol doubles. But for context around where it could go or where it's been, it's about double from where we are right here. So just be aware that, as we know, this can all change very quickly. You could get much bigger trading ranges on the weekly and the daily basis for sure. It's been pretty sleepy for now.
I mean, you got to expect that to change too. Like it's volatility has been trending lower. We are in like a little bit of a summer dull period, but it changes quickly. So I do think paying attention to that is important. And yeah, I mean, everything can change very quickly. So
yeah, I think when you look at, just even the trading activity here, the price action in the market, we had a down market in April, and then you had this very quick recovery in May. So we went from about 80-ish to 110, and we've kind of paused. We're in this consolidation period right now. We've been in it for the majority of the past month. Maybe it changes. We need to break probably 112 or so on the upside. I think if you do see that pulls in buyers, shorts cover, and you could quickly get a run to 115, 120, just kind of arbitrarily calling out some levels. It wouldn't take much to get there. That's what I would be looking for. But yeah, you have to get the break of the resistance. And we're kind of flirting with, again, the top of that range there. But it does feel like, in terms of what we've observed and historically kind of how these patterns have played out, get this big move to the upside, get the consolidation, then you get the break. The breaks have been to the upside. And the way that this is trading, the trend that we're within, you would assume, I think, right or wrong, you would assume that you do get that break to the upside. And that's kind of the period that we seem to be in right now, is that consolidation.
Right.
That said, what else is on the show run here today? We've talked about performance. We've looked at volatility, trading ranges. Where do you guys want to go next?
Let's figure out how to watch the charts, because
let's take a look at the platform.
I think the grid view is superior.
This is a new update to the web platform, something that's existed on the desktop, but here we are. Improvements, new features galore.
Mm-hmm. And watch lists, I think it'd be helpful to just show that there are existing crypto watch lists, which I can see, and then you can create your own. So if you hit that little plus icon, you can create your own watch list and add whatever you'd like to see on it.
What are we going to call our watch list, Shelly?
Wow, my mind just went.
That's okay.
In
We can
75
just call it
different
like
directions.
test watch list, if that's what.
That's lame. I think.
Tasty Crypto Show watch list.
All right.
First thing that popped in my head was squirrels.
Or squirrels. So we've got a lot of different watch lists, and we just showed the crypto watch list in here. But if you want to create your own watch list, and you don't have to just add crypto to this. This is what I love about probably where we're going, is we can add the spot cryptocurrencies, we can add the miners, we can add the ETFs, we can add the crypto companies, the proxies, the Coinbase, the strategy.
Let's add them
all in one place.
Let's add them all.
Okay. What would you guys put on your crypto watch list? And very easy to do this. You just have to type in the symbol, and then I think you can add it, right?
So Bitcoin, obviously.
Bitcoin, IBIT. Strategy. Is it still MSTR?
What is it? Yeah.
I think it's still MSTR.
Can't type. Apologies.
Yeah.
Do we want ETH on there?
ETH.
Yeah, we need a little
Solana.
ETH on there.
ETH, Solana, Ripple.
You can just type ETH and it'll pop up, right? Yeah.
Yeah.
There you go.
So what you're seeing me do here is just go in
EITO,
and
someone says in the chat, sorry.
EITO, and that's the ETF that tracks the futures, I believe, ProShares Bitcoin ETF. But what you're seeing me do here is, if you do want to create a custom watch list where you can put all these companies, all of these different instruments that we've talked about that are all related to crypto on your list, you can go in, create that custom watch list, and all you have to do is just type that symbol in, you search for it here. Once you click on it, boom, it's on your list.
Mm-hmm. So now go to the chart button on the left. And from there, I think on the right, on the right, you can put your watch list on the right panel. If you click, oh my gosh, I can't see on your screen.
WLT.
There you go.
There you go.
Now, from here, do that little grid icon, or it's like 3 squares in the middle. Yep, multi-chart. And now you can select from many different layouts. Yeah, 4. And then if you're clicked on that one and you want this to stay Bitcoin, that's fine. Click on the other one next to it, and then click from your watch list. Now that one's ETH. And so you can just swap them out. And having the watch list right there, it's easy to just bam, 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 set them up.
I like this a lot. I have not personally used this. I know it's a feature that has existed probably for some time on the desktop platform. So tastytrade, if you're not familiar, which I think most people are, has a downloadable desktop platform, but the web application has just completely evolved 2.0, 3.0, 100.0 at this stage to have all of these new features, everything on the desktop and more. This is really what we've been using on the show for the last few months or so. But this is a new feature I haven't used. And this is great because you can see everything on your watch list, or you can have these different kind of compartments. You can see the charts. You can trade off of this as well. This is really convenient.
Mm-hmm.
I would like to see a comparison. Oh, okay. I guess we already have it up. I want to see a comparison. We don't have to do this right now, but you know how there's like 3 different MicroStrategy. There's like MicroStrategy Preferred A, Preferred B, the regular equity. I wonder how those trade, and like it'd be nice to see those compared. And then the chat is going crazy over Tom Lee's company. I don't know what that is, but I don't know if that's like a publicly traded company or something.
Yeah, chat. What's the symbol? I've seen Tom Lee's popping up per usual.
Miner, is that what it's called?
Kind of pumping coins, which I appreciate, I suppose. But yeah, I think it's another an acquisition vehicle, as we talked about.
Bitmine Immersion Technologies has rebranded itself as a full-on Ethereum treasury vehicle. The company raised $250 million in a private round to begin accumulating ETH, with the explicit goal of becoming one of the largest public holders of ETH. Tom Lee, founder of Fundstrat, joined the company as chairman. BMNR. That's what it is. We should add that to the watch list. There we go.
Yeah, we got it up there. We've also put together, just to compare, and apologies, I'm not super familiar with the 3 different strategy vehicles here. I know there's a lot on these on X, but we have MSTR, STRF, and STRK up here representing those. And we also put up Bitminer. Is that what it's called? BMNR.
BMNR, yeah.
Okay.
Now
maybe I can zoom out a little bit. I don't know if this is yeah, okay. So you add Bitcoin to the balance sheet, ETH to the balance sheet, or you become a treasury vehicle, and you go up here.
You go from $1 to $60.
It is impressive.
Hold on to that rocket.
Also, howdy to Lone Sofo showing up here.
What
Late,
up?
but still here. Respect.
Late Sophos. What's up?
We need to do a deep dive on the different MicroStrategy vehicles.
Yes, we do. We should do that. That's actually a great piece of content because I've seen so much on that, and I haven't actually like deeply dove into it, but there might be an opportunity there if you're investing in the different preferred shares. You can't trade from the chart yet, though, right? There's no like place order from the chart. We don't have that yet.
I don't believe that you can do it from the grid here. If you can, I've just got to get a little bit more versed in how all of this works. First day with my new hands, as we often say. But yeah, I don't think you can trade off of the chart here, but you can quickly jump over to the trading page and set up trades off of this.
I don't know how to do it, but I'm pretty sure you can. What happens if you right-click on the chart? Anything?
No.
Not from there? Okay. We'll figure it out.
We'll get there eventually.
Now we just need giant monitors so that you can do
Yeah. I like this, though. This is an evolution of the show. We've got the watch list on here. We're going to cover a bit more than just a handful of tokens. We've got some of the ETFs that represent miners. We've got some of the individual companies. Some of these do have options. We'll start to get into that a little bit more. Obviously, the market's closed right now for options trading, but this is good. Setting up a watch list and using the new grid view, which just came out on the web platform. I don't think that we've made a loud announcement about this just yet. That's coming soon. This is kind of sneakily been inserted into the platform. So if you've been using this, congrats, you found it. If you haven't used this, we're going to use it on the show moving forward. But grid view, again, you've just got to go to the chart, and then you've got to go up here where it says multi-chart. And if you have a large enough monitor, it looks like you can get up to 8 different screens here. You can kind of change, that layout and the orientation of this visually.
You can change the appearance too.
Yeah, synchronized across all of these different categories here.
Nice.
So that's the other nice thing about it, right? If you have a process where, as we like to look at multiple time frames to kind of get a sense of momentum, you can put your indicators on here. And then you can have your 3 charts, you can have your 4 charts, whatever it might be. You've got your daily, your weekly, your monthly. Maybe you want to zoom in. You've got a 6-hour, a 4-hour. And so you can see what's happening across those different frames and might give you a sense of kind of how you want to trade it, right? Obviously, the faster moving time frame is going to give you an earlier indication, but you can check that against, well, sure, we're seeing a pop short term, but are we in a bullish or bearish trend on a weekly or monthly basis? You can see that all on one screen.
Mm-hmm.
This is awesome.
Yeah.
Not to get off this, but do you have any trades that you've placed? We have that follow feed still, right?
Yeah, let's jump over to the follow feed really quickly before we wrap things up. I did put on a new trade as of the other day. I think we should be in the green, given the movement today. You can see that, recently have bought some ETH at 2750, bought a little bit more on that dip at 2500. So underwater on some of these, underwater on 2620. We've got ETH at 2583, but buying a tenth or a quarter of an ETH at a time. We're clearly playing for some higher prices. Would love to see that get back to 3. We'll probably sell out of some of that. But elsewhere, we've got some IBIT call options that we went long when IBIT was 59. So maybe they're looking better. Bitcoin, we bought some Bitcoin at 99.4 on the dip when we had some geopolitical tensions a couple weeks ago, or 622. You can see the date there. And then the most recent trade, this is just simply based off of those price momentum signals that we cover in the emails, but went long Aave again. So this is the second time we've put on this Aave trade, just again, solely based off the signals. I have no inside information or no view fundamentally into Aave. But aside from, it's a DeFi protocol and does accrue some value in ways. But just looking at it from the price perspective, went long this at 264, 281 right now, just bought 1. So decent little trade, nice percentage return there. But again, that's just going off of the signals. And when we get a sign that maybe that's kind of exhausting itself, we get back to 3 where we were previously, maybe we look to take that off, but went long at 264.81. So you can see all these trades and track these. There's some really old legacy stuff going back, a year or so ago on here. But these are the new crypto trades, Aave, ETH, Compound, IBIT. You can see the open and the close there and track that trade and hopefully, that performance, which we hope is positive. That's the goal, at least.
Mm-hmm.
I think you've done well with that IBIT strategy.
Yeah, let's just take a look really quickly over here. Here's some of the portfolio. We got a little bit of a gold position as well. This is just a small portfolio that I trade. Long some calls in here that, are still in the red, but, a nice pop today. Got some time. The view here is just buying very low implied volatility and looking for a pop, but have a bit more to go before that turns into a profitable trade. You can sell some things against that, reduce the cost basis, but got a bullish position on there. You can see about 200 deltas in IBIT right now. So we'll see. That said, it's 5:01. That's it for our show. We've got a half day in the markets tomorrow, full day off on Friday. Be careful with the explosives.
Crypto doesn't sleep, so
crypto will be open.
The traditional markets will be a half day. Crypto's 24/7, 365.
Yeah. to that point, if you want to get your fix on Friday and the market's closed, or Saturday or Sunday, if you're like me, and you do not have crypto approved for your Tasty Trade account, if you have a cash or margin account, individual account, get over to the trading preferences, and you can do that right here from the web. You go to manage, go to my accounts, trading preferences. You can see I've got it enabled, but this is where you can enable your, well, it's not up on the screens, apologies, but you go into your trading preferences, and that's where you can enable crypto for your account. So if you want to trade on the weekend or you want to trade crypto anytime and it's not available for you, when you go to the page, just click that button. Very easy to enable that. So that's going to do it for our show. Shelly, Dan, thanks for joining me here on this Wednesday ahead of the weekend. We'll be back on Monday. Until then, I'm Ryan.
I'm Shelly.
I'm Dan.
Peace.
The market doesn't stop. So why should you? Diversify your portfolio with stocks, options, futures, crypto, and more from Tasty Trade. Focus on the markets that matter to you. See the odds before you trade using curve analysis, IV rank, and more tools. Get industry insights that help you find your next trade right where you need it. Tasty Trade. Download today.
Got friends? Get $250. We'll give you a bonus for each qualified person you refer to Tasty Trade. So spread the word and earn rewards. Terms and conditions apply.
I started trading around 2018, as soon as I got out of college. Stumbled upon a couple of different YouTube videos and learned that way. Truth or skepticism with Dylan Radigan was actually kind of what really caught me in the early stages, because Dylan was sort of the skeptic, and like I was a skeptic as well. And Tom was able to sort of convince him, and that was kind of my favorite show from the beginning. The fundamental principle that present fear of future uncertainty is fundamentally overpriced. In other words, volatility and selling volatility is the key to getting a statistical advantage in financial markets, is the biggest takeaway. And that's kind of just the overarching principle I follow.
Dear Cheapo Airlines, thank you so much for sending my luggage on a magical side quest instead of my planned destination. I am glad that I had the sustenance of the single pretzel I was served on board while I was waiting for my bag to arrive. Looking forward to your reply, because surely the response can't be as delayed as long as my flight was. Warm regards, Bettina.
Sometimes it feels good to get smart. Get even smarter with live trading insights and some live taunting.
Every day I do God's work here.
From the smart mouths at TastyLive.
Whew, let's make this quick. I gotta get going. I make $4.97 every second that I work, and if I don't clear $145,000 by the end of the day, I'm gonna go crazy.
Okay.
It's a cute dress. Where'd you get it?
Oh, thank you. H&M.
$23, 10% off sale.
That's pretty good.
Probably not worth more than $4 now. That's too bad. You got to be aware of these things. Everything has value.
Well, not everything has value.
Everything has value.
I am pretty sure I can name a couple of things that don't have value.
Go ahead, go for it.
Okay, caution.
5 cents.
Feebleness.
That's a sad one. $1.12.
I have a toughie for you.
All right.
What about us?
Me and you?
Yeah, did we have a price?
Yeah. 2 cents. We should have sold that one a long time ago.
2 cents?
Yeah, we could have made a lot of money on that one. Oops.
2 cents? I wouldn't even pick that up off the street.
Exactly. I think that's more on you than it is on me. Lord knows I'm trying. Hey, you know what, though? There's money to be made everywhere. Take you, for instance. Look at you. You're a young buck. What are you, like 37? I'm joking. How old are you?
I'm 26.
With your genetic makeup, you're not putting on too much weight. I think you could sell those little lady eggs of yours and make quite a profit online. But I wouldn't wait too long. Next month, those would go down big time, especially if you keep eating the way you're eating. I gotta take off. Time is money.
Are you serious?
Yeah. Hey, look, can you get the check on this? I left my wallet in the car. I don't like to carry around bulky things. It slows me down.
You can get up to $4,000 when you open and fund a new account with tastytrade. That's 4,000 buckaroos, 4,000 bills, 4 large, 4K, 4 grand. Get on the platform for...
There's a beast in the financial world, and it's not the bull. If that's you, join us on Tasty.
Feel like your wardrobe is missing something? Like style, purpose, and maybe a dancing dog? Can I pet that dog? The new tastytrade and tastylive web store is now live. New merch, bold designs. Did we mention all net proceeds go to one tail at a time? Invest in the real bull market, dogs. Go to tastytrade.threadless.com. Grab some gear and help some pups. You get merch, they get a home.
Oh, yeah, it's Wednesday, July 2nd, a little bit after 5 p.m. Central Time, the best time. You know what that means. It's time for Tasty Live's evening show, a little podcast. Give it a little podcast called The Price of Truth, a show where we like to explore the incentives that govern our world. More on those in just a bit. But first, it's Wacky Wednesday, everybody. It's time to introduce our plainclothes guest with no chest hair. The one, the only, Mr. Chris Vecchio. Views are going to be down 30 to 40%. Christopher, you know what the people want, and yet you keep teasing them and stringing them along. How you doing, my friend?
I figured we peaked last week with our discussion about Marjorie Taylor Greene to start the show, so there's no reason to even try to top it, right?
You know, I totally forgot about that until now. Bro,
Not
one
me.
day...
And the conversation
day-
after the show, telling you about when the light bulbs started going off over the conversation.
I have a feeling
panic
one
that
day
sets
in one of our lives, that episode's going to be used against us. Me at some court hearing or you at some Senate confirmation. One of the two.
I've actually sent that, and I faxed the URL to a number of people to give them like, the heads up. Like, you can't use this against me. I'm using it against myself. Joke's on you.
Attorney-client privilege. That's what we should change the description, the title of that episode to attorney-client privilege, and maybe that will help us. Shout out to everybody watching this. This is a trading show, everyone. Shout out to everybody watching on tastylive.com. Shout out to everybody watching on Tasty Trade desktop and mobile applications. If you don't already have both, go get them. But if you want to be part of the conversation that's taking place on your screen, bing, right here. Right here. Did we get it? Is it over here? I don't know. Somewhere in the middle of your screen. There's only one place you can do it. And that, my friends, is on Tasty Live's YouTube channel. So head on over to the evil Google YouTubes and subscribe to the channel. And hop on in there. Get your metacarpals, your phalanges moving. Bash your face in front of the keyboard or onto the keyboard to create random-ass characters. Do whatever you have to do to spoof the Google algorithm and putting us in front of as many people as possible. Shout out to all of you in the chat. I see you. I love you. But off, and away we go. Christopher Vecchio, the S&P 500, doing the exact same thing it does every single day, which is move up by just shy of 0.5%. The NASDAQ, though, recovered a little bit from yesterday's sort of, I don't know, unpinning of value versus growth, or let's call it small cap versus tech. Actually, on the positive side, up 0.75%. The Dow Jones did a whole bunch of nothing, down 2 basis points. And the Russell, again, the second day in a row of outperformance in the cash markets anyway, up 1.33%. Chris Vecchio, I say to you to begin the show, one of the smartest questions that I can come up with, which is, what gives?
It's summertime, Victor. Everything's fine. The Fed's going to cut rates in a few months. The economy's still growing. There's no problems.
Economy still growing. Do you believe that? Do you believe the economy is still growing, or do you believe? Good God, that the economy is decelerating right now, at least on paper?
Yeah, I think directionally, right? One of my long-held tenets is that when you look to GDP trackers, until you get into the 2 weeks prior to the actual release of the official government report, you don't take the number at face value. You use it more as like a directional cue. And so it started off second quarter quite strong, but over the past few weeks, the economic data has been eroding, not just the hard data, but the soft figures as well. The surveys have begun to lighten back up after what was, we'll call it post-tariff recovery. The ADP report today doesn't do anyone any favors in terms of that narrative that the economy is weakening right now. But the stock market's never the economy. So we can just separate those two things very plainly here. We know that the stock market can be detached for a variety of reasons. It could be looking through the recession. Heck, it may have priced in the recession in April. And it's going to be such a short and shallow one that by the time we ultimately see the deceleration turn up in the official government figures, we'll have started to rebound thereafter. A situation not too dissimilar than what happened last year, where you get through late July and the market has its panic over growth and the Fed's too late in not cutting. And then by the time the Fed meets in September, they say, oh yeah, we know we have to actually give you 50 basis points to catch up. And the market says like, great, but we're actually no longer concerned about growth. Thanks for the extra money. Maybe that's what we're setting up right now again. But either way, right, this is a market that, you know, it has enough of what it wants to see. Might be delusion. I'm taking the Dr. Strangelove approach. None of it seems to make sense to me except for the fact that line goes up. So I'm going to stop worrying and just learn to love the bomb while we have it.
I don't know. I'm getting worried. I don't want to say worried, but there's a part of me that is watching a lot of market participants. And this isn't really a response to what you said, but the fact that you said, I'm not going to worry, I'm using that little part, which is I think a lot of market participants were worried at lower prices and are now switching to the mode which says, I'm just going to participate to the upside because the market has, I don't know, whatever phrase you want to use, climb the wall of worry or whatever the case may be. And now that we're at, you know, these effective highs nearing 6,300, I think a lot of people, a lot of market participants are betting that way with their money. They're effectively saying like, look, yeah, I know we have geopolitical concerns. I know we've got potential inflation concerns. I know we've got uncertainty in monetary policy and potential the Fed chairman and direction of monetary policy in the future. But this thing's going higher, so I'm just going to stop worrying about all of that stuff. And I wonder, though, Chris, as we near 6,300 and perhaps stretch valuations, do you think that's perhaps the gotcha in all of this, that we needed to get to the point where there's this upside capitulation in order to get a little bit of a flush to the downside? Or do you think like we need say it again?
Yeah, we do need that. And you're starting to see signs of it creep in, right?
We don't think we're there yet.
No, but like little tells, like the fact that when the market starts pushing the highs again, you see volatility stop falling and start to go back up, almost as if like volatility is going up because people are buying so many calls in that moment. And those are little signs of exhaustion, and you're getting into an exhaustive top. But the positioning isn't quite there yet still, which to me, you really need a hefty one-sided trade for traders, for speculators to signify that you're at a turning point. And we're, you know, CFTC COT report, speculators are still net short the S&P 500. They're still net short the NASDAQ, believe it or not. So long-term fund managers, they're feeling great. You know why? What do long-term fund managers do? Do they trade every tick, or do they dollar cost average positions every month, every quarter? This has been a great year for dollar cost averagers. This has been a fantastic year for people who rotate, you know, every few weeks. If you rotated on January 1st and April 1st and July 1st, right? If you held tight, you were rewarded. Your clients think you're a genius because you saw through the fog when everyone else was losing their skin. So yeah, asset managers are bullish, but like traders are still not piling in yet. It hasn't gotten fully frothy. And so could this get stupider? Sure. Could there be a bigger disconnect? Yeah. But it also was like 2023, 2024, Victor. How long were we waiting for that shoe to drop of economic malaise? And it never arrived. And the market just kept going up. So if we can muddle through the next few months without a big downturn, why wouldn't stocks keep going up? Because we have all this negativity that still needs to be shed that's baked into price for whatever Trump premium or discount, dare I say, you want to apply to prices.
Let me go to let me. You mentioned ADP earlier, and I'm really curious. So ADP, so we get some numbers this morning. ADP comes out. It's obviously not great. Shows a shedding of 33,000 jobs. Market dips into about 8 o'clock a.m. and rallies throughout the rest of the day. And it looks like algorithmic buying. It like whenever you see a slope that's consistent for the entirety of the day, that looks like just programmatic buying all day long. Mortgage applications were like okay. And then, but ADP showed that shedding of 33,000 jobs. Why do you think that is? Do you think it's because the market is looking through an ADP report because historically it's not the greatest in tracking what the actual employment situation report will show tomorrow, which is usually Friday, but it's going to be a day early because of the shortened week? Or do you think it's because recession is bullish because we're running 7% debt to GDP ratio? We're about to pass a bill that the CBO, for whatever problems they have with their math, says it's going to add $3 trillion to the deficit, plus another trillion if you include the interest that we're going to have to pay on that $3 trillion through entirety of the decade, plus raise the debt ceiling another $4 trillion to be ready to distribute some funny money dollars in the case that they need to and don't get what they need for monetary policy. So ultimately, you get a downturn and you're going to turn on that funny money gun. And if Jerome Powell doesn't want to play ball, you replace him with somebody who will. And I'm just curious, like, is there a reason to be scared of a downturn in the real economy from the point of view of the financial assets that I'm looking at on a day-to-day basis, Chris? Do you think the market looks through it because ADP is just not that concerned about it? Or do you think you look through it because Trump's going to do whatever he can do to hold on to political power and favorability? And that means turning our dollar into Tic Tacs if necessary.
Trump doesn't have a favorability rating that's above water right now, right? So if he's doing things to be concerned with being popular, I have a hard time thinking that's what his North Star is, right? He seems to be doing things that he wants to do. And maybe some might say like, well, to do the tough things, they're going to be unpopular sometimes. I personally don't think that's why he's seen his poll ratings fall in the way that they have, or why the One Big Beautiful Bill Act is polling where it is. I genuinely think that people don't want to see Medicaid cut. 17 million people potentially losing access to Medicaid, Medicare, right? That's a lot of people, right? And, I'm sure there are some Trump supporters in there who rely on those programs who are like, wait, I was all for dunking on liberals and, Doge, but I didn't think it was going to happen to me, right? Like I need my medication still. So if he was really concerned with doing what's popular right. So let's just back off that for a second. I have to reject that notion. But to that point, the deficits are huge. And like what makes Trump feel good is what the people around him say to him. Like he likes being surrounded by his yes men, and the corridors that he views into, he wants to see people patting him on the back. And so will $4.5 trillion of tax cuts offset by $2 trillion of spending cuts make him popular among the people that he cares about? Yeah. So I think that he's fine with this, and that means we're going to get the bigger deficits, the bigger debts. We're going to keep pumping financial assets for the foreseeable future because government deficits are private sector surpluses at the end of the day. And given the distribution effect, right? If we look at the CBO scoring or Tax Foundation, find anyone, go out there on your own. I'm not a do your own research kind of person, although I think that is the job we have. We really do our own research here. So I'd recommend anyone else to do it themselves. But to that extent, look up a nonpartisan and independent objective score of this particular piece of legislation and look for the line items where they discuss where the money goes to, like which income decile benefits the most from this. And it's really going to be the wealthy. And I think that matters because if we want to talk about how money's spent and who gets the money matters, right? If I give someone who's in the bottom 25% of income earners, an extra $100, chances are they're going to spend that on things. If I give someone who's in the top 25% of income earners an extra $100, there's greater odds that they're going to save it, okay? Because their spending needs are being met already. And when you give that money, all those funds to the top 1%, top 5%, top 10%, chances are they're not just going to save them, they're going to recycle them back into financial assets, into real estate, because Why hold on to the extra cash? So could this be really inflationary? Could that K-shaped recovery post-COVID continue as a result of this bill? I think so.
It will, for sure.
Right.
It won't, I don't think you'll see the same type of inflation in the CPI because the money's not going directly to the people. So you can have monetary inflation, which we will see, we could see inflated asset prices, but the cost of things at the grocery store don't go up like you saw during the Biden administration. I should say, I think a lot of that had to do with distributing money, those stimulus checks that were actually sent out during the Trump administration, and then the lack of supply we were creating at the exact same time. So you have a lack of production on one end, and then you have a lot more capital that's distributed to the masses, which now can bid up the price of goods and services. But in this particular situation, you're going to see all of those COVID-era savings spent down, still monetary inflation getting pumped into the economy. It's just going towards a group of people who don't need to bid up goods and services, Chris, because they don't buy as much goods and services, and there's fewer of them. They buy monetary assets. So all of this money goes out. This $4 trillion goes somewhere. This is what I keep thinking about. And I feel like we just saw this. We saw this in the Biden administration when they spent trillions of dollars in a couple of these bills, the Build Back Better, the Inflation Reduction Act, and a few others. And it was like, all else equal, I think we would have saw a slowdown. It would have been, but we pumped so much money into the economy via fiscal dominance that it really changed the outcome that we perhaps versus what we would have seen otherwise. And I feel like people have forgotten that lesson, and they're looking straight in the face of $4 trillion plus a $4 trillion raise in the debt limit, and they're just going, well, I'm calling the recession again. It's like, well, why don't you just see this as the exact same thing we just went through, but instead of money directly to the individual, money is going to the business this time, or to the business owner. And so it's going to show up differently, but I don't know that the results are much different, Chris.
No, I don't know the results are that different. And it seems to me this is just, a story of bottlenecks. And that's really every trade, every investment. It's a story of where's the bottleneck. You want to own the bottleneck, right? Where was the bottleneck at the start of the AI story? Semiconductors and chips. What happened when DeepSeek happened in January? Our perception was that the bottleneck was no longer in chips. It was going to be an application. So the companies that had the superior applications, now they had the upper hand in the market. Right? Because we were moving beyond the theoretical, the build out phase, beyond selling the picks and shovels, we're moving into the gold rush. And along those lines, we look where bottlenecks would be if we're doing things that we're going to reduce the labor pool in the country, make materials more expensive, raw materials more expensive. If we're going to pour a ton of money into the top of the funnel, and as Ilya likes to say, it really is trickle down economics because it just comes out in a trickle. It doesn't come out very fast to everyone else. What happens to those funds, right? They got to go somewhere. Water always finds a level. And when it's a different type of inflation. So you're going to get weird things like velocity of money falling in the economy, right? Mm-hmm. And like slower structural growth overall. That's what some of the CBO's estimates have put out, that the economy is going to be smaller in 5 years' time, in 10 years' time, in 20 years' time as a result of this legislation, whether we like it or not. And that's not at the benefit of, we have to do things to run a smaller government, spending habit and raise taxes and get surpluses in order to fix the deficit and debt. And you know what? We're willing to trade off a little bit weaker growth to start fixing our finance problems. But that's not the case. CBO is saying that we're going to have a weaker economy, bigger deficits, bigger debts. So I don't know what this helps besides Bitcoin, gold, which Bitcoin is looking really, very quietly, Victor, back in the futures market. Nice little bullish engulfing bar today. You look at IBIT or the continuous BTC contract, starting to look like we're breaking out a little bit here. No one's talking about it.
This thing's going. I think, I don't know if this thing's worth anything, but I think we go to the moon first before anyone, and if it's worth nothing, and this was all just a giant Ponzi scheme, and then they pull the rug on everybody, who knows? Maybe that its ultimate destination is somewhere in the, in the single digits sometime in the next 5 to 10 years. But I just don't get why it's not. I've asked so many people, I've talked to so many people, I've read so many of these books, and I just cannot figure out for the life of me why somebody could look at this and go, this is nothing. This won't be around in 5 to 10 years. Like, I cannot understand why Jamie Dimon or Gary's Economics come out with the opinions that they come out with, Chris. You know what I mean? Like, are you fully on board with this, or is there some part of you that goes, I don't really know if this is anything? Are you still in that camp? Like, there's some part of you that goes, I don't know if this is anything, but I got to own it as some non-correlated volatility, or as some play that says I'll regret it if I don't have 2 to 3% of my chips on this, on Black 13, something like that.
Well, that seems
Are you a hardcore
really
believer?
accurate. No, I'm not a Bitcoin
Is
maxi. No, I'm not a Bitcoin maxi. No, there was definitely part of me early on I was like, hey, the global financial crisis happened. These people are kind of like F the banks, and I understand that sentiment. So yeah, consider me a fan in a certain regard. But also that's probably why Jamie Dimon and other people in institutional side of finance were so against it, because you have a group of people who create this new asset class out of thin air, which is effectively, the genesis of is because the bankers weren't punished enough during the global financial crisis, right? So you're not exactly going to be partial to these people or welcoming them into the tent of traditional finance, as it were. There's a business angle there, right? Jamie Dimon has no interest in saying, yeah, Bitcoin's the future. Those guys who designed a system to replace the banks, they're correct. Mm-hmm. I don't know if that works for shareholders at the end of the day. So there's, right, you talk about a world governed by incentives. I just think certain participants in the market are there because, even like the CFTC, some of the regulators out there, are they really representing the public, or are they representing industry participants? But ISDA is a great example. The International Swaps and Derivatives Association, they determine whether or not someone's gone into technical default. But who comprises the committee that determines whether or not a corporate or country has gone into technical default? Representatives from the banks. And so if the banks don't want to see their assets defaulted on, right? Like, oh, this person owes me money. If they default, I get nothing back. How about we all agree that none of us are losing money here? There's been no default. And that's what happened with Greece. So incentives govern the world, as you like to point out. But yeah, so the point is everything. If it's Trump, what he's doing at the national level, or even something like what's happening in the city with Mamdani here in New York, pronounced it right that time, Victor. He says he wants to build like 200,000 new units. New York City's goal from 2016 to 2026 was to build 300,000 new units. So we're going to have a 10-year program effectively that's going to have a lower pace of government financed affordable housing than we did in the past. And we're going to talk about raising taxes, and we're going to talk about giving tax cuts to the super wealthy, but raising them locally in New York City. I mean, this just seems like a really interesting mix where it can do nothing other than push up asset prices in the stock market, push up gold and Bitcoin. It seems highly inflationary for all the wrong reasons. But again, if that's where we're heading, we want to be where the puck's going to be, which is why I'm still long stocks and long Bitcoin and long silver. Let's get on the crazy train, Victor.
Yeah, I'm on the crazy train too, but I'm just not chasing. For better or for worse, I'm not chasing the highest priced and the highest valuation assets, like the hype train, the AI hype train. I rode that for a while. I'm off it. I probably regret getting off it a little bit. I think I got out of NVIDIA around 100.
Let that be the warm blanket that you wrap yourself in, that I wrap myself in. I'm not chasing this market. The first time I got really, really bulled up in stocks, right? 42.36 in the S&P. I remember it because it was like my best trade that year. It made my year. Mm-hmm. So I've been on this ride I'm not chasing this thing. I have been in the front car from day one. Sometimes I take a break and, I got to go to the snack car sometimes, right? But that doesn't mean I've lost my seat on it. So
yeah, I try to be chill in my everyday life, but when it comes to this thing, I'm like hyper competitive, super hyper competitive. So what I mean by I'm not chasing is I still want to outperform, and I want to outperform other people to a large extent. But I want to get there through like what I think are the best risk and reward bets that I can find. And sometimes I'm right, sometimes I'm wrong about those. But do I think NVIDIA is the best risk? Do I think putting my money in the Mag 7 and just letting it ride is a good risk reward? No. Do I think that has outperformed? Yes. For my entire adult life, I said this on the podcast the other day, for my entire adult life, being a big dum-dum and putting my money in the highest beta assets would have outperformed. And I've seen a lot of people who don't know anything about the markets come in, put their money on black and let it ride and make a lot of money. And I'm not necessarily jealous of those people or in any way wish them any harm. I'm glad that people are participating in markets and making money. I like that. But I think for me, if I eke out through a lot of hard work, dedication, whatever, if I eke out a really nice gain for the year and I do it without chasing the big, dumb Momos trades, and I'm doing it through what I think is like smart allocation of capital. You find the nuclear theme before they come knocking on it because people go, oh my God, how are we going to power the whole AI, all this AI stuff, or the gold miners. And right now I went down the rabbit hole in the home builders and I haven't stopped talking about them for like a month. And I finally got paid a bit yesterday. They all had a 3 to 5% lift. And I was really curious, was that a one-day thing? Was it a one-day thing because you had three things all at once? You had, as Ilya mentioned yesterday, Sequa, but I don't think that was the whole story. I also think you had value finally outperform growth in tech yesterday by 200 basis points. Russell was up 1% while the Nasdaq was down 1%. So I think these things all have single-digit forward multiples. So these are all in the value bucket. So if you're just algorithmically going out and saying buy value over tech, sell tech or sell growth, these things are in that bucket. Also, bonds had lifted up to 115.5. So my biggest question was, would this theme continue? And what was most interesting about today is bonds took a hit. Bonds were down pretty significantly. On a relative basis to how they've been moving. So down to 114.30. And this theme, these home builders still performed pretty well to the upside, about 1.5% or something like that was spread across the board. So I'm kind of excited about that. But to my original point was, I'm hyper competitive. I want to outperform, but I want to get there through what I think is the best risk reward bets and smart allocation of capital. That's what I mean.
Can I pitch you on coal then?
Beautiful, clean coal. You pitch me on coal, and the next theme I'm developing, I can't find value in it, but it's water. So let me hear your coal thing, and I'll pitch you on water.
The government is giving tax cuts to do more coal.
I saw.
And
taxes and putting taxation where there wasn't any in electricity.
In electricity, yes, but solar and wind, those are rescinded. Which, like, why would you tax more energy? We want, again, I'm an abundant energy person. I want nuclear. I want hydro.
Agreed.
I want natural gas. I want all of it. I want a big base load, Victor. Right?
Who else is like that? China. China's like that.
Yeah. Well, we need to build the transmission lines. Which are we doing here? Okay, so coal. Look at like BTU on the screen, for example. Look how it performed after. Peabody, right? World's largest private producer of coal.
Holy shit. Up 11% today.
Look what it did after the election, though, where it was trading. Okay, come on. Like, go to the end of the year. Go to the October. Go to the October. Okay, so you can buy like the $25 call spread, and I think it's like a 10-to-1 risk to reward. Like, come on.
That's crazy.
Come on. Like, I say this as, again, I am a bleeding heart climate change believer.
Where's coal come?
Coal is something you gotta trade.
What's the state with the most coal? Is it like, who's the senator? Is it West Virginia? That's what I was going to say. Because it used to be Manchin, right?
Yeah. And now it's Jim Justice, the former governor who switched parties.
What's that lady's name?
Wyoming did, actually. Wyoming produces 40% of U.S. coal production. The next largest producer is West Virginia at about 12%.
What was the lady's name? Is it Murkowski?
Alaska?
The one who voted for the bill and then tried to say it was a bad bill. and a lot of people are going to be hurt. But like I saw her interview, she said like, you know, my job is to represent for Alaska, and we're different. And once I saw the way this thing was going, I just had to do what I had to do to get what I could for the citizens of Alaska. I just was like, goes back to the incentive thing, man. It's just like prisoner's dilemma. If everyone acts in their own self-interest, we all lose. We only gain if we all sort of collectively understand the Nash equilibrium, what's best for all of us. And we just won't do that. We just keep acting as individual selfish actors in the system at the political level, and we're going to keep creating bad outcomes for everybody. And there's no better example to that than what Lisa Murkowski did and then what she said. I couldn't believe it, bro. What do you think about that?
I can believe it or not. I believe that happened. Because she got pork, right? Like, did you know? You now have, I think, whaling captains, Victor, will pay lower effective taxes than you or I now. You and I are in the wrong business, my friend. Okay. But Victoria Spartz, Rep. Victoria Spartz said this. She's from Indiana. She said this earlier today, like literally less than an hour ago, or less than 2 hours ago, in fact. She said, I'll vote for the bill since we need to make it happen for our economy and there are some good provisions in it. However, I will vote against the rule bringing it to the floor due to broken commitments by Speaker Johnson to his own members. So she's against bringing the bill to the floor, but if it's there, you know what can I do? I got to vote for it.
Yeah, dude, it's ridiculous, man. What's the deadline that they're operating on? They want to get it done by July 4th. Why? Just because the president wants it as an announcement? Or is there some, like, if you don't get it by this date, then you miss a deadline for taxes? I didn't think that there's no reason not to take more time. Is there? Other than I want this to be announced on July 4th.
There might be, but like the TCJA didn't pass until December 2017, and it didn't go into effect until January 1st, and we're in the middle of the year. So the changes in tax law aren't going to go into effect until next year. There's some things that are retroactive, like there's an incentive for having a kid. Maybe that's part of the Trump. Is it the $5,000 thing for having a kid, or are you talking about the investment? I do like that. That's one of the only things that I liked in the whole stupid bill. No, that's really smart. I think you and I have talked about this before, how the incentive for representatives, liquidate your private assets. You're forced to invest in SPY and TLT. And because if you're making policies.
What are you talking about? That's not what I'm talking about. What are you talking about?
I know. I'm saying for kids too, it's a very similar situation for kids. Like the second kids are born, give them some equity in the future of the country.
Yes.
Right.
The problem, though, is it makes all of us more. The reason why people like Brad Gerstner want this, I think there is an aspect to this which is good. The problem we keep running into is we keep going, okay, how do we fix wealth inequality? Raise the minimum wage. It's like, bro, are you kidding me? The reason that there is such a disparity between the haves and the have-nots is asset ownership. So you don't fix that by raising the minimum wage. And it's like, how do we have a society that keeps trying to fix this problem by raising the price of labor per unit of labor? It's like, bro, we need to change the distribution of asset ownership, and therefore, as this thing appreciates, because that's what it was built to do, that more people can benefit from that. And we just keep having the same dumb conversation.
When was the when was the last time the federal minimum wage was raised?
It's been a while. Like Obama, I think, right?
It's raised from $6.55 to $7.25 an hour in July 2009.
Yeah, that was after Obama got elected.
$7.25 an hour, Victor.
Yeah, I know, bro. But again,
that's a problem.
Yeah, I don't know. There's another part of me that goes, well, what if you don't have $7.25 worth of skills to exchange in the marketplace? Then you're locked out. And then let's say if we raise it from $7.25 to $15, what everyone would get happy about that. But I'm telling you, what happens in an age of AI when you raise the price of labor from $7 to $15? What you're doing is you're saying anybody without $15 worth of skills to add to the marketplace, we are going to automate your job away. You're not going to be able to exchange your labor for wages. So I don't disagree, but whatever. California's a great case study in this. They raised minimum wage over in California. People lose jobs, bro. All those fast food joints, they just automated this stuff away. And I think Gavin Newsom gave one of his buddies over there that runs one of these chains a sweetheart deal, so they didn't have to raise their minimum wage. But like, I'm not opposed to raising it. All I'm saying is that it does have consequences that we don't seem to talk about. But anyways, my point is, I like the idea. I like this idea, but what it also does is it creates exit liquidity for Brad Gerstner and all of his partners and portfolios that he runs. Just a nice passive bit of exit liquidity just by having children. And then the other thing that it does is we're already so held hostage to the market because of our 401ks and everything else that's locked into this. It just creates a greater hostage situation for the U.S. as slaves to the marketplace and to doing things that positively benefit the
Victor,
assets.
We're already slaves to it.
I know.
If you don't,
and
if
this
you
just
don't own
brings
any
us further down the path.
If you don't own any financial assets and the stock market crashes tomorrow, do you think that your town is going to be affected? What about town's pension fund?
In a world where, look, I like the idea. I'm just saying that it's just going to create a new sense of awareness for the market.
We need more skin in the game. We need more.
I agree.
I
don't disagree. I'm just saying there is always a trade-off, and this is, to me, there's a trade-off there, which is like, there's a group of people right now that might vote for a representative that say, I don't care what the market does because the market doesn't impact my real world. Exactly. And so sometimes I think that might be okay. But in a world where even the lowest wage earners want to do things that prop up the market, you've now created an incentive that, again, disproportionately benefits the asset owner. Because now even labor says, I don't care about the markets. I want this for me and my community. You're going to get rid of that. Now everyone's voting in favor of policies that will positively and disproportionately benefit the asset owners, what I'm trying to tell you. I'm not saying it's bad. I'm just saying it is an outcome.
I love how you have to always do it's not saying it's bad because you know that I'm going to go, so then how far is too far? Are we advocating for completely free labor? Should people even have the decision not to work? Should we just throw people into shackles and force them to work? Right? Like, what's the most efficient cost model there?
What?
But you disclaim that. We're not going towards a slavery conversation about the model of, like, what's the cheapest input? And isn't that the conversation over immigration here? And this is one of the things that I feel like a lot of people on the left are talking past. Like, yes, I think that people who have been upstanding members of the community, give them asylum to some degree. But also, are we accepting the argument that we should have a class of people who live in this country who do work at subservient wages, and the only way that we can keep our economy on 2 feet is by having a class of subservient people who work for subservient wages? Like, that's not a comfortable reality or conversation that a lot of people want to have. But we need to say these things.
Can I offer you that?
That's the cheapest model, free labor.
Can I offer you that? Singapore does that.
Well,
Singapore effectively imports a lot of foreign-born workers for construction. So like Bangladeshis, I think Pakistan, India, they come over. There's better work here at more attractive prices than where they come from. They get lodging. It's not great lodging. They do get lodging. They work really hard. Singapore erects buildings faster than I've never seen construction work as fast as it does in Singapore. They do the same thing domestically. So like, let's say women from the Philippines or Indonesia or all types of places that are sort of poverty stricken. There are no opportunities for jobs. They come over, they apply for these domestic helper visas. They stay with their individual employer. They make money. They send it back home. There is a different class of work pass for those people. Let's say if somebody comes over and they're a CEO of a company here, they have a different work pass, work visa, same thing in the US. But neither of those two that I just mentioned are citizens of this country. They have a longer process, not as long as the U.S. It takes a couple of years to then apply for some sort of like PR, permanent residency here, or even on a long enough basis citizenship. But I guess what you're talking about is a model that exists in the world, and it doesn't exist in a way that is like ultra oppressive.
Is that a cultural thing though? Like
What do you
I feel like that's the model that America has, and there's a large part of the population that says no, we don't want people coming here from abroad and taking our jobs, right, and doing the work that we would do otherwise. Not that Americans are going to be out in the field picking strawberries.
I think this time around, it's not a taking our jobs thing. I think in the past, when a lot of American industry was about low-skilled work with our hands, I think that was the thing. It was taking our jobs, whether it was right or wrong. I think this time around,
So
I think it has a lot more to do. I think it has a lot more to do with the benefits.
Okay.
I think it has a lot more to do with the benefits that go out, and whether or not people agree with that level of benefit that is going out to I don't know what they call it, migrants or illegal immigrants, or I don't know what the word is, but I think that's sort of the crux of the conversation.
Sure. I mean, I think the number was, I saw it quoted from the CBO yesterday. Someone community noted one of AOC's tweets, but it was something like the U.S. spent like $4.8 billion on benefits for migrants last year, which
I think
you want to. Okay, but let's just say that's the number.
Okay.
How many magnitudes more are we raising the debt to cut Medicare for 17 million people? 2 magnitudes higher? 3? Right? 4.5 trillion versus 4.8 billion. So, hey, I mean, at least UPenn wiped away those swimming records, Victor.
Oh man, there is such a better way. There is such better legislation that could be passed, but that place is just a big bribery ring. It's just a big bribery ring, and that might have worked if the representative was representing a pool of people and not individual interests. So we get ourselves in this situation because I got myself to Washington because I got 2 or 3 big donations. So at any opportunity, I'm looking for the kickback to those 2 or 3 individuals. And that's why this stuff is so warped. It used to be, I'm going to do the thing that benefits the most people in my state that continues to get me reelected to come here. But it's not a vote thing. It's just, if I get enough money, I can put enough money in Facebook and TikTok to get these people to do and think whatever I want them to think, and they'll put me back here.
I'd like to think it's a little bit more complicated than that.
I know you would, but it isn't.
What I say,
it isn't.
Given my intimacy with the process, but in many cases, it's not.
My thing is, and I'm way late on this, but I do think the third order from this, this AI craze, just to get back to that individual symbol discussion. By the way, nice rally here in NVIDIA after a 2-day fall. We're back nearing highs again. They'll eat up anything you give them. But I think as soon as the U.S. figured out that we were going to go through the scaling model, the open AI scaling model, and not like the DeepSeek efficiency model, we're going to do the scaling model. And even after DeepSeek came out, it's like nobody cared. We're still going to plow forward with the scale. Then it was like, okay, well, we got to power this stuff. And so then the nuclear thing comes on. And I think at some level, people are going to be like, all right, we got to cool these data centers. And I've been really looking for, and that I'm sure that's already happening and already getting priced, but it's not a mainstream theme yet. And so I've been looking through all of the water utilities, trying to figure out where in the United States is most conducive to building data centers over the next, 5 to 10 years, and then which of the individual regional utilities might best benefit from those bets. So I got a handful of utilities. So I did the home builders, and my next one that I've been waiting to do is water. There's a handful of companies I like.
Interesting. Okay.
None of them are super cheap, though. They trade sideways for like the last 5-10 years.
They trade sideways, but it's kind of like when you look at XLU, for example, it's not exactly the sexiest action over the past 6 months. But if you've been selling puts in there, or in the companies that are the biggest components of XLU, you've been having a fine time, just collecting income here little by little because the market's relatively stable. To answer your question, data centers are being built mostly in the Mid-Atlantic, and in particular, like Virginia has the highest concentration up to Pennsylvania, in part because fewer earthquakes, you're not going to have wildfires, reliable infrastructure connected to some of the major metropolitan areas in the country close to New York. Also important that like Wall Street's backup centers are over in Allentown, Pennsylvania, so having ample power supply in PA.
I thought they were in Jersey.
No,
in Jersey.
No. If let's say a nuke goes off in Lower Manhattan, backup data centers in Pennsylvania get turned online, but they get routed through Mahwah, New Jersey. So just like one of those things you want to. So the Northeast corridor is where all the action's at. You're interested in water utilities.
Let me give you a few. I'm going to give you a few ETFs real quick and the people.
Okay.
So instead of the individual stocks, which is the way I'm going to play this, I'll just give you a few ETFs that go along with this theme. So this is Invesco's Water Resources ETF. None of these are super liquid, mind you, and you can kind of see what this one has done since those April lows. 58 to 72. FIW is another one. Which is the First Trust Water ETF, same idea. PIO, Invesco Global Water ETF, same thing. This one a little bit more outperformance since those April lows. CGW, I'll give you one more. There's a few others, but I'll just stop here. Invesco S&P Global Water Index ETF, another one. So you can see these things are going crazy to the upside. Since April, a lot of stocks have done this V-shaped recovery, but the last two ETFs I showed you even more so than the others. I just, that's what I'm saying. You're not getting a great price here. I wish I'd have been smart and thought about this ahead of time or picked up some of these during the April volatility. But, I'm watching them now. All right, you were saying?
No, I think the theme is, looking at this legislation and how I know the trope. I call it a trope because nothing's guaranteed in life, that Democrats are going to win back the House next year. With the retirements and shifts that we've seen in the Senate, Susan Collins is probably going to lose her seat, given where things stand right now. And Tom Tillis is a prime Democratic pickup as well, who just announced his retirement this week from North Carolina. But even so, that still only gives you a 51-49 Senate. If you're a Democrat. So Republicans are probably controlling the Senate after 2026. And that's today after, when you look at polls, Dems look like they're going to take back the House. But let's say they don't take back the House, right? Nothing's guaranteed. They were expecting a Democratic wipeout in 2022 after all, and what happened? That wasn't the case. So maybe it's the same way for Republicans. Trump gets all the nasties out of the way early. You mentioned this months ago. You do all the uncomfortable things early on in the term, so by the time the calendar goes to 2026, we've had the market fall, we've had the change in legislation, the economy's rebalanced before the elections occur for the midterms. Maybe that's what happens, right?
And you can take credit for it because all the bad things that happened were Biden's economy, and now we're in 2026. And look at the stock markets, everybody. This is the Trump big beautiful bill.
Right, and it didn't matter that we had to have a 20% decline in stocks to have a 25% rally in stocks. All that matters is that we had that 25% rally in stocks back. And that's political messaging, right? Everyone does that. But you work through this year, so whatever is happening with this legislation is likely to have a shelf life until 2028, maybe longer, because it's no guarantee that the parties change power significantly. If maybe Democrats win back the presidency, but who's to say they win back the House or the Senate? Things change. So here I say short healthcare companies that are related to or highly dependent upon Medicaid reimbursement funding in rural areas. Long coal, short rural hospitals is the play. And there are a few like senior health care facilities and home health care providers that rely like 20%, 30% of their revenues are federal Medicaid disbursements, and they were down 2% yesterday. And maybe they're a little bit better off today because this bill's on rocks. But if this bill passes, it's just a penciling out dollars and cents. Like there are 2 hospitals in my area, not in my county per se, but within an hour's drive that would be in consideration to just shut operations completely if this bill in its current form passes because of how dependent they are on Medicare reimbursements. And that negatively impacts me, Victor. You know why? Because those people who go to those
to your hospital
get sick still, and they have to come to my hospital. Okay, so when that's more demand and strain on my services, and so that's more inconvenient for me, and that's great. I have a kid coming in a few months. I want a crowded hospital.
That goes back to the immigration thing too, man. If you're in a city that just got 30, 50,000, 75, I know what I'm trying to tell you is the same thing that I lived in the city of Chicago. Getting in an emergency room in the city of Chicago, it was impossible, bro. There was a couple of times we had to take the kids into I'm just saying, I've said this a million times. I think there was just a way smarter way to go about reforming in a more transparent way to go about reforming our immigration and increasing the amount of immigrants in the country than the way that we did it. And so we stress services everywhere, all social services, including hospitals. So to the same extent you're talking about with this bill, which would negatively impact the services in your area, well, anyone that lives in either one of these border towns or one of these sanctuary cities, completely flooded. All of their services, your schools, your hospitals, your everything.
But you and I have been clear-eyed about this for many months now. But the fact that it took Greg Abbott and Ron DeSantis busing people up to New York City, and you're adding, even John Fetterman to this, the guy has many faults, including the fact that he looks like he does not want to be senator. You listen to his what he's saying. He's like, I want to be at the lake.
Who, Fetterman?
Yeah, Fetterman? He's so checked out. It's so funny. He's so checked out. But like he even
you think he's checked out?
You absolutely checked out. But the point he brought up a few months ago, when you're adding the population of Pittsburgh to the country month after month after month, right? That's going to strain resources. And like that happened in New York. You look at hotel prices in the city in the post-COVID era. The city started using a lot of these hotel rooms that because of COVID weren't being used, they were vacant for immigrants. And then once the economy reopened, now there was less supply of hotels. And so hotel rates shot through the roof. What's New York City's biggest industry? Tourism. And so tourism took a hit, which in turn deprived the city of taxes, which it was already suffering from because people left during COVID. And so they have a lower tax base. So you get this like negative feedback loop all of a sudden. And I'm very sympathetic. I think America's a melting pot, right? We should all melt together. But, they're even working this out with my town right now, talking with people about building more housing here. There are people who want to just open everything up, open up all the zoning. And then there's the pragmatists like myself who go, well, what can our sewage handle? Oh, our sewage can only handle like 100 more people living here right now within the town's borders before we hit our capacity. So how do we do this? Do we want to build 100 new homes? Should we build multifamily housing so it's a little bit denser? Do we need to build new sewers? Right. But like you can't just build. There are constraints on systems and you have to work within those constraints and then fix and grow the systems to accommodate over time. But you can't shock them. Otherwise, the system can fail.
I wonder who came up with that statistic and if they have like this range. So they have a vol on that. So it's 100 plus or minus, let's say 30. And it depends on the diet of the people who come in. If we get 100 people who are on keto or like vegans, then we can only have 70 of those because they poop more. And if we get a bunch of like more bread based or carnivores, then we can get maybe 130 of those because they have less bowel movements.
Meat eating gym bros who just absorb all the protein and don't go to the bathroom.
I'm so curious what analyst came up with that statistic, and then did they put a range on it, and then what went into the range?
Yeah, no, but like those are the kind of constraints that you have to talk about. And so like we have our I'm a believer in, like, if I want something to occur, I am more than happy. It's what Reagan said. I know people don't like when I quote Reagan, but if someone offers you half a loaf and you want a full loaf, you don't smack it out of their hand. You accept the half a loaf and then you go back and ask for more.
Or you eat the half a loaf and you say, hey, there was something wrong with that half a loaf you gave me. It was expired. I want a refund. I want the other half. That's what I would do. If you don't mind, can I ask you one more before you get out of here?
I'll allow it.
Vietnam. Trump said we did something with Vietnam. You've been talking a lot about sort of the incentive structure between China and Vietnam. Trump said they struck a trade deal and imposed this 20% tariff on imports. What say you on that level of tariff on Vietnam relative to that gamesmanship that you were concerned about between Vietnam and China?
Well, part of the deal that's announced with Vietnam is that they're not going to allow themselves to be a transshipper. So the tariff that's being charged is 20% tariff for Vietnamese exports into America and a 40% tariff, right? So they addressed it. And so that concern that you're seeing in some of these data points out of Southeast Asia, where, like, Singapore is my flag that I like to wave. In a single quarter, they're importing enough NVIDIA GPUs that would consume the entirety of the country's electricity production for 1 year. So that's clearly not happening. And they're not letting these sit on a shelf and rot because the technology gets better and you want to use it now before it gets stale, so to speak. So, like, clearly it's a pass through. So they have to address this. You can't just, you have to do a comprehensive Fortress America type of approach where you plug the holes. So I do appreciate that is occurring because we don't want excess supply from China, excess capacity dumped into markets, and we don't want them finding ways to work around our export controls. So win. But moreover, you look at something like the retail, look at XRT, for example, the retail ETF. That obviously had a really good performance recently thanks to Nike, but XRT was the ETF that took the biggest beating after the Federal Reserve meeting in December. It never recovered to highs like the broader market as you made your way into the new year. It fell the hardest and the fastest as we made our way through the tariff talk and growth scare, in part because you look through history, the retail ETF is the ETF that historically loses the most during recession periods because it's all consumer spending. So the fact that it's performed the way that it has and has basically erased all of the losses that we've seen since the February 21st growth scare, that is a tell in and of itself. I really like that. I really like what's happening with KRE here, Victor, the regional banks. You mentioned before, which we skated by, rates are up, but so's the Russell today. Well, rates are up maybe for oil's reason. Oil is up. And if oil is up right now and it's non-geopolitical reasons, then, hey, I guess it must be demand. So sure enough, the EIA data showed that U.S. crude imports absolutely surged last week, 2.9 million.
Copper up significantly, too, over the last week, and it doesn't seem like many people are talking about that. Copper's nearing highs, so for whatever growth concerns this market had at one point in time, it's pricing something different in copper and in crude oil to a lesser extent.
I do have to go, but what was you were mentioning the green room before. What was your take on Diddy? All right, anyway,
I didn't really see the whole thing. I can't believe they dropped a bunch of those charges, but I have no idea. I saw the headlines of that. I think they put him away for like prostitution or something like that. I think from what I've heard, that seemed to have more than just prostitution going on in that whole ring. But that's for another talk for another day. Christopher, if people want more from you, tell them where they can go.
At CVECUFX, Twitter, at CVECUFX. You can find me here on Network Monday through Friday, Futures Power Hour, 1 p.m. Eastern, overtime, 4 p.m. Eastern, Monday through Thursday. Let Me Explain on Wednesday, 6 p.m. Eastern. And no, that's Tuesday mornings, 9:40 a.m. Eastern. It's The Praise of Truth on Wednesdays with you, Victor, at 6 p.m. Eastern. But we're off air tomorrow for Futures Power Hour and overtime, as well as Friday. So I will see everyone on Monday.
All right, man. You have a good one. This now that Diddy has been put away for a while. This now makes Chris Vecchio the #1 importer, purchaser, and consumer of baby oil in the United States. Congratulations on that title, Chris Vecchio. I'll see you back here next week, my friend. For all of you, hit the like button as you get out of here. Subscribe to the channel if you haven't already. This is our Synthetic Friday here, so we won't have a show tomorrow. We'll see you back here next week. Until then, peace.